Welcome to another episode of Real Deal Investing. I'm Jerron Kelley, real estate attorney and multifamily investor. My co-host, Larry Mastropieri, also a multifamily investor and a real estate broker. Welcome, Larry.
Thanks.
Yep. And today we have a really special guest. We've got JJ Gilbane. JJ is a multifamily investor, very successful young man, and he has put together a portfolio of right around 200 units. We're going to get into sort of his background and how JJ was able to assemble such an impressive portfolio in such a short period of time. We're excited to hear that, but more excited to have you here today.
Thank you. Very excited to be here. Thank you both for your time. Very excited. So
Good.
Thank you.
Excellent. Well, great. So let's just start off with a background. Tell us a bit about kind of where you're from and how you got into real estate investing.
Absolutely. I grew up in Providence, Rhode Island. Sports was my life for my entire life. And then I was in college, and college was starting to come to an end. I had to figure out what I wanted to do after that. So I started to look around at my friends, my family, and said, where do I have the most connections, and what do people do? And for me, most people in my family and my friends were in the commercial real estate space in some capacity. So I started to talk to them. What do you do? And fortunately, one of my cousins connected me with a firm that in New York City, and I got hired a few months after graduation. Went to New York City, worked there, and was in New York City for 8 years working commercial real estate, primarily on the debt side, lending to borrowers across the country. And it was great, but I always knew that I wanted to do something on my own.
What kind of debt? What commercial debt, obviously, but
yeah. So I worked
traditional debt. Were you brokering it?
Good question. I worked at a bank and I worked at a private equity firm. Okay. At the bank, we primarily financed existing stabilized properties. So a Walgreens in Denver, Colorado, a multifamily building in New York City, stuff that was kind of already cash flowing.
Got it.
At my next job, I did more ground up construction financing, special situations. You know, someone was in the middle of construction and their loan was maturing and they needed a new loan. So it was a little bit more special situations, but I always knew that I wanted to be an owner operator.
Got it.
And so when I turned 30, I had been working for about 8 years in New York City. I decided that I wanted to go off on my own and see if I could start something. And I had thought about it a little bit. I knew that I wanted to get into multifamily. I just didn't know where. So I talked to a bunch of mentors that I had, and I said, you can download these national reports of fastest growing cities and fastest growing rent growth and all that stuff. And, it can lead you to a lot of different places. Do I want to go to here or there? And you're like, I don't even, so talked to a mentor of mine who said, hey, South Florida is really interesting. This was pre-COVID, so 2019. Got physical barriers with the Everglades and the ocean. Got a lot of people moving there, and it might be worth you thinking about. And so my parents have had a place down here for the last 15 or so years. So I said, great, I might have a free place to stay while I go down and look for opportunities. And
always helps.
Yeah. And so that's what happened. I knew I wanted to be in multifamily because it was an asset class that I felt I had the most experience in. I thought it was easiest to understand for me and potential investors. And then South Florida made sense because one, I had a place to stay while I was down there. And two, where I'm from in Rhode Island, a lot of my family and friends come down and they vacation down here.
Right.
Some people have homes down here. So a lot of people love their golfers.
They have some familiarity with the area.
So I was imagining getting them behind investing in multifamily in Palm Beach County or South Florida would be something people would be excited about. And that's something to think about too, is not to jump around here, but think about when you are doing deals, we can't pay for all these deals all of ourselves, right? So we have to think about who we're going to partner with and what's exciting to those people. And for me, in my network, I thought South Florida and multifamily would be an exciting pitch for people.
Yeah. I've taken a syndication course, which we'll get into syndication here shortly and how you assembled the portfolio and what that's like. But in the course, one of the things they said is that when you're looking at areas to invest in or to underwrite deals in, number one, first, the easiest area is, of course, the area that you live in. Mm-hmm. But if you don't want to invest in the area that you live in, like you were in Providence, the second easiest is an area that you vacation in or that you have some familiarity with. It's much harder, let's say we're in Boca Raton here, South Florida, to go underwrite deals in Kansas City, Missouri. I've never been to Kansas City. I don't know anything about it. Right. How do I know what neighborhood is good? Or if I'm looking at an asset, is it in a Class C area or Class B area? And sure, you can call brokers and, ask people's opinions, but your information is only as good as their opinion is good.
Correct.
So I think that you made a wise decision to go to that area that you vacation in, you have familiarity in, your family does, and of course other people that you network with, I'm sure, and grew up with in Rhode Island. And I'm sorry, Larry,
Still a big leap of faith, though. Like I've had a hard time investing outside of Palm Beach County, and I've been here since 2005. So I was living here, working here, operating here. So I already understood it really well. How did you familiarize yourself more with this area to the level that you felt like you could deploy millions of dollars, right?
Yeah, I think first and foremost, I have to thank my mentors and the people who steered me down
Sure.
here. This wasn't the number one place I was going to come to. So
Where were your options? What were you thinking?
I was looking at the west coast of Florida. I was looking at Tampa.
Okay.
I think it was Florida for me, but it wasn't necessarily Palm Beach
Southeast
County
Florida,
or
Palm Beach
Southeast
County, yeah.
Florida.
Got it.
Tampa was exploding in 2019. Everyone
was.
said Tampa. So I was spending a lot of time trying to understand there. And but I will say it's not like I came here blind. That I think is a very difficult thing, as you said.
Yeah.
I had been coming down here since 2008. My father and mom had a house in West Palm Beach. We would come down for the holidays. I had friends who lived down here. So it wasn't where I grew up, but I was very familiar. My parents were building a house down here. I knew the contractor. And so I had a lot of leads, if you will, and I knew a good amount about the area. I definitely didn't know as much as I probably needed to, but it was a warm lead. It wasn't a completely cold market that I'd never been to. I had a lot of connections and people, so that was very helpful for sure.
Great. Good. Yeah, sorry, we interrupted your
No.
time frame here. Go ahead. Yeah.
So started the firm, multifamily, South Florida. And then from there, the business is about opportunities, investment opportunities, and capital. So you're always working on both. So I came up with a list of everyone that I knew and said, do I think that this person might be interested in investing in a potential multifamily opportunity in South Florida? So I put together a little teaser, 3-4 pages that overviewed, this is the area that I'm looking in, this is the type of asset, this is the vintage, these are the projected returns that I think we could achieve. And I would send that out to people and say, hey, just so you know, this is kind of what I'm doing. And if you're interested, let me know. There's nothing right now. And people would come back and say, yes, please, let me know. If you have something, no, sorry, not interesting. And then I would obviously try and find deals. So that's talking to brokers, that's talking to attorneys, that's talking to, I would talk to anybody. Oh, my friend's father has a landscaping company. Great, I want to talk to him. Where does he landscape? How does he landscape? What do you think about? What are the bushes that don't have roots that go into the plumbing underneath the building? So I will meet with anybody. Great. And my grandma lives in Palm Beach County. Great, I want to talk to her. How does she like it? What restaurants does she like? What areas does she not like? So, and I did that for about a year. And, as you can imagine, coming down, no income, you're trying to figure things out. It can be trying. And then eventually a guy that I got to know brought me a small 4-unit deal. And that was the first, as most people talk about, you start with a condo and then you start with a 4-unit and you grow. And that's kind of how I went about it too. And we bought a 4-unit property in West Palm Beach and me, 2 friends and my father. And we still own it today. And it's a great little property. And But it took a while to get to that. I think, everyone sees.
The first one's always the hardest because it's whether it's psychologically, emotionally, whatever it is, because you're learning, you're scared, it's getting over the fear, and you're just learning a whole
Momentum is like a thing. Yeah. It really is. Well, in 2021, I was buying quite a bit, and that momentum allowed me to continue to buy pretty aggressively because I was just like, oh, I just transacted over there. I know exactly what's happening right over here now. Oh, I just moved rents from that to this because I have the asset down the street. And so I was able to just quickly, within 3 hours of a listing coming on or some agent calling me, I'm just like, here's the offer, So, and now as we've slowed down a little bit, I feel less ninja at the moment, right?
Yeah, we all do. We all do. And I think you become someone who is a potential buyer to a guy who buys deals. Even if you close a duplex or a 4-unit, like, hey, I just bought this deal over here. Oh, that guy just closed on that deal. And so then you start to, like you said, you start to get the momentum, you start to gain confidence.
Well, another thing too is I've really found that it's so important to have these broker relationships. We've talked about this a couple times, Larry, but I'm sure you were going to get to this anyways, but creating these broker relationships, when these brokers hear that you've just transacted on another deal, they know you're serious, because I'm sure they're getting multiple phone calls, emails from other people that are saying they're investors, but they kick tires and they're wasting their time. And when a broker knows that, hey, you've done something recently nearby in the 5 or 10 mile, radius of where they concentrate, they're a lot more likely to send you those deals that are off market or up and coming or about to be listed, that kind of stuff.
Yeah, I'll back up, because yes, when you do a deal, it's great, but doing a deal is very, very difficult. You have to, first and foremost, find an opportunity, which is very difficult. I mean, we all know you probably look at 1,000 deals for every one that you do.
It's really difficult here.
And it's so competitive. It's competitive everywhere, don't get me wrong. But South Florida, you could argue, is probably one of the most, if not the most competitive market to buy commercial real estate in.
I really think it is.
We're biased,
I really
right?
think it is.
In the last 4
really
years, it's become that. Yeah,
No question.
It wasn't that way 10 years ago, but it is that now. Yeah.
So
much money is here, and you have all these people with money. They're literally moving here. Before, these people were living in New York, they were living in California, they were living in New Jersey, Massachusetts. Maybe they would deploy a little money here, but now that they're living here, they're actually moving their money here, either to their financial advisors that are in Palm Beach or in Palm Beach Gardens or in Boca Raton. But while they have their money in equities and they're moving it from their New York financial advisors, they're also deploying their real estate capital here, and they're 1031ing money in here. And I see that on my closings that we do on our transactional side, that the last year or more, there are still a lot of transactions where people 1031ing, using 1031 exchange money to move in here and overpay for properties, because they just want their assets and their money to be here in South Florida, even if they're overpaying. So I agree with you completely.
So it's extremely difficult to find an opportunity. You look at 1,000 and there's one that you close on. Then once you think you find a deal, now you have to think about, where does the money come from? I primarily use debt and equity. So the equity is going to be me and a friend, or me and a relative, or me and a couple people. And the debt is going to come from a bank, or it's going to come from an agency, or a private equity firm, or a life insurance company. And so there's a lot of hats that you have to wear. And getting that first deal done, I would tell people, ask for help. Ask for help. People who are residential broker. I mean, how many deals do attorneys? You guys see deals all day long. And by the way, residential and commercial, at least in the multifamily space, are not that different. So talk to your residential broker, or talk to an attorney that and ask for help. And I think that's the biggest thing, is have the humility to ask anybody for help. And don't think you know everything. Assume you know nothing. I still tell myself every day, you know nothing. And you have to be flexible with your assumptions, and ask for help. And it's just, and then you find the money, you get a lender, then you got to close. Something pops up during due diligence, you got to figure that out. And so it's not an easy thing to do. I know we talk about, you close a deal, now you're out, got momentum. To get to the point where you close a deal is very, very difficult. And for me, I raise money on a deal by deal basis. And so I don't have a pre-raised fund. A lot of people do, right? That's usually the two ways you do it. You have a pre-raised fund, or you raise money on a deal-by-deal basis if you're raising money. If you're raising money on a deal-by-deal basis and you're going under contract on something, you need to be pretty confident that, one, you have the time to talk to people, that you have a group of people that are interested, and that you can get to a certain level pretty quickly. So that's where you have a list. That's where the sending out someone a 2 or 3 pager, hey, this is my strategy. Just getting that relationship warm
in advance
of the
deal. Yeah.
Then when the deal comes, you say, hey, remember I told you about my strategy and the potential returns? Here it is. Here's an investment memorandum. Here are all the comps. Here's my plan. Here's who's going to be helping, and this is how we're going to execute it. And now that person is, unless something's changed, is probably, oh, great. This is exactly what you said you were going to send me. Let's do this.
For me, using that method of partnerships, JVs, joint ventures, like kind of what you're talking about your first deal was, or a true syndication where you might have 8, 10, 20 investors, depending on the size of the deal. The only problem I have with that from a personal perspective, not that the strategy is bad. It obviously works for a lot of people, but for me, is going out to sell myself before I have an actual deal makes me feel like an emperor with no clothes. Like I'm just selling myself, and it's I don't. Was that a challenge for you in the beginning when you were first doing that? You're reaching out to your list of contacts, and you have your 1 or 2 page sheet of types of investments you're looking for. Was that first call or two that you had? Was it hard, and did it get easier and easier as you made more calls? How did that look for you?
It definitely is hard. It's the chicken and the egg, right? You need experience to raise money, and in order to raise money, you have to have experience. And hey, I've never done this before. So you kind of have to say, oh, what did you do in the past that might help you do this in the future? Or let me explain to you who I've talked to and how I understand this and how it's going to work. And be honest. Hey, I actually don't know what's going to happen if someone doesn't pay rent and we have to do an eviction. We have a great attorney who we can work with on that. So I think initially people, they don't invest as much in the deal, they invest in you. So they say, hey, I trust Larry. He's a great guy. I've known him for a long time. He's honest, and he's going to do what's right for me and my money. And let's think about what it was like in 2020, 21, 22. Interest rates were 0, right? So if you had money, putting it in the bank did nothing. You were losing money to inflation. Your money got less and less powerful. If you want to put in the stock market, multiples on equities were crazy. So most people said, I'm not investing in the stock market. It's too overvalued. There's going to be a correction. Fixed income, again, interest rates are 0. So there weren't a lot of places to put your money. So real estate was a really interesting place because it's a hedge to inflation, right? Costs go up, you pass it through to the tenant. So for a lot of people, they were sitting on money and they said, I don't even know what to do with this. So investing in someone that I know, that I trust, in an alternative asset like real estate is an interesting place where I get a dividend. We invest in cash flowing assets. We don't do ground up construction. So from day one, you're getting a check every quarter. Hey, I'm getting a check. There are tax advantages. Obviously, you guys know that.
Of course.
Of owning real estate, doing cost segregation analysis. So if you look at the tax adjusted returns, you might only be getting in the first year, 3 or 4%, yield. But if you adjust it for taxes and you're actually showing a paper loss, divide by 40% or whatever tax bracket you're going to use, and maybe it's a 7 or 8. And now you compare a 7 or 8 to something else, and you might say, this is actually really interesting. And not only that, I'm helping someone I know. So I think that you go to people who trust you and know you, they say, I don't care what the deal is. I trust you and I want to support you. And I have the ability to do that. And so I think that's the biggest thing is that, your reputation, the way you do business, and showing them that, hey, I'm not going to be over leveraging these assets. I'm not buying a property and getting 90% financing. Like, whoa, but hey, we're going to stick to about 50% of cost because we don't want to do anything crazy. And that gets people comfortable too. A lot of times in these smaller deals, you'll have to go recourse as well personally. Sure. So I'll put my personal balance sheet up as well and say, hey guys, not only am I investing in the deal, but I'm guaranteeing the loan, which is not ideal. But sometimes with smaller deals with, you get a lot of mom and pop owners who don't have leases or don't have, and we know how these properties operate because we're down here and we have properties that are operating. So the lender might say, hey, listen, this is tough to underwrite. All month-to-month leases, tough trailing 12-month financials that are tough to understand. So we need a little bit of recourse here. And in times I've done that to not only show the bank that I'm in the deal, but to show my partners, hey, I'm not only putting my money in, I'm actually putting my balance sheet up for this deal. And so I think that
gives that added layer of trust.
Right,
yeah.
right. So
besides your experience, your money's in the deal, and then also your credit and your name is on the line.
Not that you have to do that, but in smaller deals, a lot of times you do.
In most cases, they're making you do that, right?
Right. Yeah. So it's less. The people care less about the deal. Like you said, emperor with no clothes. They don't really care about the deal. They care about you, and they care about what you're doing and the strategy. Most people are like, all right, Florida, multifamily. This guy I know, I'm in.
That's for me, just to give a little more background on why I said about the emperor with no clothes. It's not that I feel that I have no clothes, because I put together a portfolio of 37 units. My wife and I, just us, have no partners, which is decent for,
it's great.
Yeah, it's okay. it's just to get to that next level of leveraging not only our money, my wife and I, but also other people's money to 1 + 1 = 3. Creating that added value, creating joint venture partnerships or syndicating deals. It's just it just requires that extra layer of confidence to know that you are adding value and you have that experience and that other people will trust you with their money. It's just that next step in your investing career that I'm in the process of actually doing now through that syndication course I took. So yeah, I don't know if you have thoughts on that too.
Yeah, for me, again, me and my
You have a
partner. Yeah,
you
me
put
and my
together more or less 100 units, which is very impressive. But
yeah, and we've done that, and we've had people that wanted to. We have people to this day. We have a Rolodex of people that would invest with us, and we haven't done it mostly because there's like just this level of added complexity to doing it. And if we had the money to do it, we just knocked it out. And deals are so hard to find that if I had an infinite amount of deals to do, well, I'd be probably syndicating more, right, or doing something of that nature. But we haven't done it yet because we haven't wanted to go through that level of complexity. And then back to like, you probably experienced this on your first deal. It was a 4-unit and it's small dollars, right? And you got 4 people in the deal, each of them own a unit basically, right? And so I don't know what the rents are on that. It's $1,500 a month, whatever. So each person's making $200 a month. So it's like, and now we've just created this whole complex structure. I got the accountant doing the bookkeeping. People want to be paid out in the next days. And for a 4-unit, it's good for the first deal, right? Totally, not knocking it at all. But like that's like what we wanted to avoid on like the duplex that we pick up. And we picked up quite a few like single family home to like quadplex level stuff. And it's just been not perfect for syndication. So the complexity isn't perfect. Yeah.
Yeah. If you can do it yourself, great. There are pros and cons to both.
Sure.
I think the limiting factor is the lack thereof opportunity from my perspective, more so than anything. Because I haven't run out of money yet.
Right.
It's not like I'm turning deals down because I don't have money. That's at least been my experience. Like it's so hard, back to your point, it's so hard to do a deal that's good in South Florida.
And it's very competitive. I mean, I do this full time. When I wake up in the morning and when I go to bed, I'm thinking about trying to source deals and capital all day long. And, you have a different job role as well, as do you, right? So I'm competing with the firms in Miami that have 50 of me that are cold calling and emailing and knocking on doors. And that's really tough to compete with. And you guys are competing with people who are doing this full time. Yeah. And other people competing with you who actually live here, who are doing it part-time. So there's just so much level of competition. Agreed. And it's really a full-time job.
And you have amateur competition too, which is frustrating in the sense that some people will show up and like pay a ridiculous number for something, right? Mm-hmm. And they might do that deal. Or they'll put it in the seller's head that they can possibly get that deal done at that price, and the math just doesn't even remotely work. And so you get that craziness too. At least some of those, the bigger firms now, they have the ability to buy at higher prices because of their cost of capital is a little different too. So you got those guys that are willing to pay up because their cost of capital is different. You got amateurs that are paying up because they're just doing poor deals. And then you have foreign money that's investing here because they just need to get their money out of a specific area and they just need to park it, so they'll pay up. And then you got 1031 money that's trying to dodge debt or taxes, and so they'll pay up. So you got this complex situation where if you're just a realistic investor that's just trying to cash flow, it just doesn't work sometimes.
I think there are two things that I think about when you talk about that is one, patience, and two, not going after highly marketed opportunities. I think you have to be patient in this business. Real estate is not a get-rich-quick game. Online, it looks to be. A lot of people online.
And the sales guys, they're selling the courses. Oh yeah, I'm invested in 2,000 units and 3,000 units, and I'm living in a mansion. It's number one. Maybe the guy's 60 years old and been doing it for 30 years. And actually the course I went to, the Rod Khleif course, he's a great guy. He's super experienced, but he even talks about in the course how he got rich and then went broke in 07 through 10, somewhere in that time frame. He was invested in syndicating thousands of units, and he had to give the keys back on so many of them, and gave the keys back on his home, his mansion over there on the west coast of Florida, and then had to rebuild himself a second time. This time he said he's not doing it the same way. He's being much more conservative. He sees that we're entering, stormy seas, and so people learn. Even the most experienced investors do that.
Yeah, I think patience is the most important
right.
thing, right?
Yeah.
You listen to Warren Buffett, and he says, I don't care what the stock does today or tomorrow, I'm here for 50, 60 years. So if you tell yourself, I'm going to be here and I'm going to be buying properties for the next 50 years, if you miss one or two here and there, it's not the end of the world. You don't have to bid on every single deal. And it doesn't happen immediately. Even if you buy a deal, you might make a little bit of money off the buy or whatever, but you have to hold. And so you have to be patient. And then two, for us, we don't like to look at highly marketed deals because of how, one, not only competitive they are, but two, you a lot of times get pushed into a corner, especially when the market's good. Today, I think it's a little bit more of a buyer's market than a seller's market, but we've been coming out of a very aggressive seller's market. So they say, all right, we're blasting this to 10,000 people, the group in California, the group in Texas, the group in New York, in Rhode Island, and wherever are looking at it because they're saying, I don't like what's going on in my market, Florida. I mean, people who look at Florida from outside of Florida think it's like, is there just 1 million people moving is it like the hype is real. Mm-hmm. And don't get me wrong, we're here and we're seeing that. Is it as crazy as everyone makes it? Probably not, right?
Not.
But people want to invest here. And so what I'm saying is that during those marketed processes, you're competing with, as we said, 1031 buyers, people from out of state who want to get down here, want to plant a flag. And not only that, but it's the terms that are difficult. So the pricing may not be, it'll probably get bid up because there are a lot of people involved, but it's the terms. So they may say, well, if you want this deal, you need to put hard money day one. Well, I haven't even seen the property. Well, you got to put hard money. Do you want this or not? And so now you get into a situation where you put, your own capital or your firm's capital at risk. Now, if you're down here and you know the building's really, really well, and and maybe you can do that, you've been in there before. But I don't like being in situations where it's a beauty pageant and I have to make myself look better than the next guy. Even if I'm paying a similar price, I'd rather deal directly with one broker and an owner or just directly with the owner and say, listen, here's what I think it's worth. Here's what I'll pay. This is why. It'll be smooth. I need a little bit of time to do due diligence. And then after that, we'll close. Here are my terms. I'll look you in the eye. I'll shake your hand. I'll be there. I'll pick up the call at any point. And for a lot of the owners that we've done business with, they really appreciate that. They've owned these assets for a long time. They know the tenants personally, and they don't want to have 15 groups come through, knock on doors, go in people's units, and especially when COVID was happening, people were afraid of COVID. Mm-hmm. So they said, hey, no one can come, so you got to get comfortable not going into a unit, or I only want one group. So that's the way we like to do business is in one-off situations where you may be getting a little bit of a discount, but it's not, for the most part, there's so many transactions happening down here. People know what their properties are worth, but you at least get to work with someone one-on-one and look them in the eye and have a relationship where it's not totally transactional.
Too. It's not hectic where, like you said,
high
you
stress.
Probably have to go in day one, no inspection period, hard money. Money's hard. That's scary. That's going kamikaze style. Sometimes it works out and you get a great deal, but other times if you do that, you get a disaster on your hands.
And like I said, that comes back to the patience thing. I don't need to buy every deal. I don't need to do every deal. Mm-hmm. If I have high conviction in something, I want to do it, great. But it's the people who are like, we have to do this deal right now because our fund, we only have an investment horizon until 2 months from now. We got to get this money out or we're not going to raise the next fund. Yeah. And so I don't want to have to compete against those people. So that's, I think, patience and then trying to find unique opportunities that are not the widely marketed ones are where you're probably going to have the most success.
Obviously, you can go to brokers and make relationships with brokers, which I'm sure you do. But as you know, the downside of that is that then you're obviously going to be competing against multiple investors. You just mentioned that. You can still sometimes find great deals and you can be the highest bidder and win those deals, but that's going to be a lot more difficult. How do you find those deals one-on-one without a broker? Are you knocking on doors? Are you making calls? Are you mailing? What are you doing?
Yeah, well, first and foremost, I want to say that the brokers are by far and away the best way to get to deals.
Agreed.
No question.
Agreed.
I love brokers. I love working with them. I in no way try to avoid them. They're fantastic, and they are really the lifeline to this business.
I agree.
And a lot of times, even these deals that are quote unquote not marketed are still through a broker. So, I would say 95% of the time you're working through a broker, even if it's not a widely marketed listing agreement that goes out to 10,000 people.
So a lot of these are off-market broker deals that are brokered. They bring them to you. I've purchased a couple of those. I know Larry's purchased some off-market deals. Two of my best deals were off-market through some of these guys, and I think we share some of the same contacts.
Right, right. And so, an owner, brokers are paid and make money by knowing owners, right? So brokers know everybody. Who owns this? Who knows here? So you get to know the brokers and you say, hey, this is my buy box. You come up with I want 25 units or greater. I want built after 1975. I want concrete block construction. I want maximum 2 stories. I want no elevators. You don't make it too specific. I usually just say, 25 units and greater built after 1975. And that's it. I want to make it as broad as possible because I want to see as many deals as possible. I'd rather tell them that I don't want to do it than then not send it to me where I could have done it. So I would say brokers are extremely important, and I love working with them. Now, there have been times where I have reached out to owners who own properties near me that are friends of friends, and sometimes that can work. And what I'll do is I'll either cold call them or I'll leave a note in their door. Those are really primarily the two ways. But I don't know if that return on effort is there. I think you could arguably just stick with the brokers. And because a lot of times these sellers, as I said, they know the brokers and they say, listen, I want to sell, but I don't want to do a full marketing process. Bring me 1 or 2 buyers. And if you can be those 1 or 2 buyers that the broker goes to, says, Larry and JJ, we're going to go with you. Now you're in a position where it's just you and one other person. You're not competing against 100 people. So I would say, foster and grow your broker relationships, get to know them personally. It's not just about the deals. And to the extent you have the time or have certain assets that you really like and you think are in great locations that you'd love to own, call them. Everyone you can look up. Most of these properties are owned in LLCs. The LLCs are with the Department of State. You go on the Department of State website, you see who the manager is. You look up we can find someone's number or email pretty much anybody. So, so I would say if there's certain assets you really want in your markets, then I would do that. But I would say 90 to 90% of your transactions will most likely come through brokers.
So you guys may know this, Jerron. I have cold callers on staff for my residential real estate brokerage, right? And so that's part of our business model. It works decently. And for a period of time, I had more cold callers, and they were calling only multifamily for myself, right? And I did. This is probably 2018, 2019, I did some off-market deals direct from those cold call leads, right? But over time, I pulled back on that. It's, to your point, the return on effort, even when I'm paying someone to do it, it just wasn't efficient enough. And the reality is, and the deals that I did pick up were like small deals. So again, like that return wasn't really there. It's best to, what I do is I have a CRM for any of my clients on the residential brokerage side, and my commercial real estate contacts are also in that CRM. And so they're treated just like prospective clients in my CRM, right? So like I got people's birthdays, I got people, whatever, just all that. It's there, and I'm just reaching out to them when they pop up in my CRM to call them, and I just have a conversation if I haven't been talking to them already for deal-specific things. So
I think also that the cold calling and reaching out is great, you made a point about smaller properties, right? A single-family home. There's probably, if you look at the percentage, chances that you're going to actually sell or buy that property, if it's single-family home, is probably the highest. Condo, also probably the highest. duplex, and as you go try for, once you get to 150 units, you're most likely not calling the owner and having him sell it to you one off, right?
It's going to be hard to find the owner too.
Right,
Once
exactly.
you get to those types of deals, and then a lot of times they're partners or they're syndications or who is the owner.
Correct, correct.
Even the property managers barely know who the owner is sometimes. So on bigger deals.
And so that's where, for us, I try and execute in a range that is below the super institutional people that are, hey, we don't look at anything less than 100 units, but larger than the local investor who buys short-term rentals and Airbnbs, duplex, quads, whatever. So call it, I like to say 25 units to like 150 units is like the strike zone. 150 probably is a little bit more institutional. So maybe like 25 to 100 is really where you can still find opportunities, and you can take sub-institutional real estate and operate it in an institutional way and fundraise for it in an institutional way. It's like a normal private equity roll-up, right? You buy a bunch of dentist offices and you roll them up and you sell them to private equity. Not saying that that's necessarily what we want to do, but I think, it's this story as old as time, is you kind of go after the smaller opportunities and you operate them in a very efficient way. And then whether you want to sell them together or individually, but I think it's important to find your niche. How many units, where is it, who's it with, and then obviously you have to have a great team. This is a team sport, which is, one of the other reasons I like real estate is I love sports, and it's a team sport. You have to have an attorney, you have to have a broker, you have to have a property manager, you have a leasing agent, you have your partnership attorney, you have your landscaper, your plumber, your electrician. It's a whole team. So that's a really important piece as well.
Do you have anybody on staff on your team, full time?
Yep. I have a property or a project manager who's full time. He's fantastic. So we've done 6 investments in Palm Beach County. So he's boots on the ground every day at pretty much all of those properties, depending on what's going on. The strategy we like to do is value add. So we don't buy stuff that's newly renovated, that's turnkey, and you buy it and you go away. We buy stuff that has never been touched, built in, call it 80s, 90s, 2000s, has never been renovated and needs some love. And so we will paint driveways, exterior fences, landscaping, roofs, and then when units turn, do some sort of renovation, whether that's just new appliances, whether that's more than that. But our project manager is boots on the ground every day overseeing all of that. So we're doing a huge roofing project. We're basically replacing all of our roofs. We've got 45 buildings or something where all these roofs are getting done. So he is on the ground every day making sure that, okay, here's the status. They stripped the shingles. Now they're putting the underlayment. They had to replace this much drywood. We have an allowance for this much replacement of plywood. And the fascia's torn here, so we have a drip edge. So he's really my eyes and ears on site. He's amazing. He does our unit turnovers. If someone leaves and we need to go in and do some repairs and cleaning, he does that.
He physically does it, or he oversees the guys?
It depends on the scope. But he usually, for the easy unit turnovers, he does it. If it's plumbing, he can do some plumbing, but the bigger stuff, we'll hire a plumber. Certain AC stuff he can do, but we'll also bring in a licensed AC guy. And then kitchen cabinets, stuff like that, we usually use someone else. So if he can do it, and he can pretty much do everything, he does. But to the extent we need someone licensed or pulling a permit or something like that, that's.
And you have 200 doors, right? And at what amount of doors do you think a project manager makes sense?
Yeah, so the first unit we bought was a 4 unit. Second property we bought was 76 unit. And then after that, after that was a 14 unit. And so those first 3 deals, I was doing it really myself. So I would be on site every day. Okay, this unit came vacant. I'd go in, I'd take a video, I'd come up with a punch list, and then we use a third-party property manager, which is really, really, really important in my opinion. And this is a whole nother topic, but self-managing is not what you want to do. By the way, it looks enticing. Hey, I don't have to pay a property manager. That's money I keep in my pocket, but it's short-sighted. And not only is it helpful not getting calls about toilets being broken, but the relationships that these third-party property managers have, that's how I met you, right? Mm-hmm. So is huge. So you say, hey, what plumber to use. Our property manager's been in business for 10, 15 years, right? So they've been through 20 plumbers. They've got the best 3 guys to talk to. I don't have to call 20 guys to figure out who the best plumber is. Same with electricians, same with the air conditioning guys. So using third-party property management has been huge. It's such an important part of our team. So really it's me, our project manager who's boots on the ground overseeing and doing some work for us, and then our third-party property manager who is doing that. So to answer your question, I think you can oversee a lot of the project management work, meeting with roofers, meeting with the HVAC guy. I would say it was probably 100 doors. And then my fiance at the time, now wife, said,
enough's enough.
Yeah,
we need you back in your life. Yeah. Enough 12-hour days. Yeah.
Exactly.
Yeah.
So I would say something like that. But it also depends. If you're doing this full time, you can do that. If you're not doing it full time, you obviously can't. So you have to hire someone.
But tell me if I'm wrong here. You were still in a growth phase because you're now at 200 units. So you're taking time away from finding deals,
Correct.
Underwriting deals, negotiating deals when you're there doing punch lists on turnovers on properties. So what is the best use of your time?
Definitely
What is
not
the value
that.
of your time? Definitely not that.
Definitely not that.
Not painting a wall.
But at the same time, I have to say that learning that type of stuff
It's important.
is so important, right, Larry? In your business, if you just say, hey, buy this home, it's great. Like, oh, what's the air conditioning? Don't worry about it. Just buy it. Why do you care? You'll fix it in the future. But if you know, oh, it's a 2-ton AC and this flooring is vinyl plank and this is marble countertops and this is sourced here and this actually more, you bring a lot of value. So for me, don't get me wrong, the first few months of doing that was not the highest return on my energy or effort or time, but it allowed me to learn a lot about how to turn over units and renovate units and bid things out and, level bids from people and negotiate. And that has been extremely important for me. So I don't think I would change anything, but it's definitely important to think about the highest and best use of your time, what you're best at.
It allows you to be able to underwrite deals better.
Absolutely.
And that's the answer.
That's the name of the game.
So you need to go through that,
Yeah.
in my opinion.
Yeah.
That's how I think about it. Because and on top of that, you got your project manager and your property manager calling you up, and you're managing all these assets, but they're calling you up and saying, hey, these are the issues, and you can have a constructive conversation with them saying, well, let's use this material in this case for X because I think that's the right answer. And they may have a disagreement with you on that, but at least you can have this constructive discussion and make educated decisions because you have experience in it. And I don't think there's any other way to do that.
Yeah. But it's so important to have people around you who know more.
Sure.
Right? Like my property manager, they manage probably 2,500 units across Palm Beach County. They've seen everything.
Yeah.
We have an issue, they've seen it.
Yeah.
That's huge. I wouldn't know what to do half the time. Oh, hey, we got a violation because we have a fence that is leaning over. And who do we even talk to about that? Do we go to the city? He knows exactly the person to call. He's friends with them. That's huge. My project manager, when I go in and I see that there's an issue with a cabinet, I don't know how to do that. I could Google it. I could look on YouTube, but he actually knows how to do it. So finding the areas where you're not as competent in, I think that I'm good at sourcing opportunities. I think I'm good at finding capital partners. I think that's probably what I'm best at. I'm absolutely not best at, turning over a unit or renovating a unit or figuring out how to install something or managing or dealing with tenants. So finding the areas that you're not best at, definitely trying to learn as much as you can about them. Not saying I'm not good at that, plug it with a hole with this guy, I'm not dealing with it. Learning about it, but making sure you have the people in whether it's a sports team or in business, finding the right team to support your weaknesses is really important.
If you're talking sports and you're talking like soccer, it's like the goalie is as important as the striker.
Right.
Right. So it's just like on some level, right? So it's like you just need to find your role and in the machine that you've created. And that's your role, what you just described. I agree 100%. Yep. And I learned that too the hard way. I had 4 units in Boca and then bought an 8-unit in downtown West Palm in a very rough neighborhood. And the day after we bought it was stormed by SWAT. They pulled out a guy out of the unit. Chaos. I had no idea what I was doing. I almost sold what was that, 12 units at that moment in time, made a decision that we were going to work through this, and got through it, hired the manager later on, and it was a game changer, right?
Yeah, I think it's important to remember, and this is in life, that it's never as bad as it seems and it's never as good as it seems. So when these things pop up at your property, you say to yourself, this is too much. I'm spending so much time dealing with this, it's too much. Or when COVID hits, no one's going to pay rent. We got a problem. The bank's going to take this asset. Or hey, everyone's moving to Florida. Rents are going up 20% a year. Oh my gosh, this is going to be forever. I'm the smartest person in the world. And it's just not true. So you have to be level-headed. You have to understand that you're in this for a long time. There are going to be peaks and valleys. Some years are going to be great. Some years are not going to be so great. I think the most important thing, in my opinion, is to not over-leverage with financing from banks or life insurance companies or whatever, and not have huge maturity risks. That is how you get in trouble in this business. So, as I mentioned earlier, we try and call it 50 to 60% of cost on our financing. And we've done historically all 5-year fixed rate loans that maybe have a year or two of interest-only payments, meaning you're not paying down your principal balance, but eventually you start paying down your principal. So in year 5, and these are value-add assets, so we think that we can increase the net operating income a lot, you should be in a good place. That being said, there is maturity risk. If the world is upside down in 5 years, even if we think we're 20% leveraged, and you could have a problem. So I would say the people who have taken on 12, 24-month, 36-month floating rate
scary
is scary. Now that being said, to the defense of those people, if you look back in 21, 22, and you said, hey, I'm going to buy a property, then I'm going to renovate, and you look at the options, just fixed and floating. At that time, the index, SOFR or LIBOR, was basically zero, and then you had a spread of, call it 350 over. So you're paying 3.5% interest rate. You could get a fixed rate loan for 3.5% too, but the problem with fixed rate is the prepayment penalties. So with a fixed rate loan of 5, 10 years, a lot of times you have either yield maintenance or defeasance or step down prepay, which basically means if you want to sell this in year 1 or 2, you got to pay a fee to the lender. So if the three of us own a great property and in year 2, some 1031 buyer comes from California and wants to pay us 10x what we paid for it, we might have a very significant prepayment penalty. Some people, millions of dollars. And they go, why didn't I borrow floating rate debt? There's no prepayment penalty after maybe first 18 months. The interest rate's the same. Why did I do this? Now, when rates go up 500 basis points in a year, now the fixed guy who took fixed rate money looks a lot smarter because now your interest rate's a lot greater. You have to buy caps for your interest expense. That's becoming a lot more expensive. So the answer is, and there's no real answer, every asset's different, but in my opinion, for buying cash flowing multifamily is get some term, I'd say 5 years, go fixed, and don't over-lever. Keep it to 50 to 60%, and you should be okay. It's great. Hey, well, I can get 75% leverage. I only have to put 25% down. There's a lot of risk with that. And but at the same time, if you fix today, let's say we're going out to get a loan and we got a 7% loan, we fixed it for 10 years, and the Fed decides to drop rates 300 basis points tomorrow, we're like, oh no, we can't refi, we can't sell because we got a huge prepay either on a refi or a sale. So the answer is financing is always it's kind of
more of an art than a science.
And there's no winning. Like playing the interest rate game, well, if I hedge this or I do fixed, you're never really going to win. It's just a source of capital. So for us, what we've done is, you look a lot smarter when rates are going up. Oh, you fixed a low interest rate, you're a genius. Could have gone the other way. I mean, I guess it couldn't have because rates were zero, but just be careful. That is the most important thing that I think anyone would tell you in this business is you get in trouble by over leverage in anything in business and real estate and having maturity risks. So taking out a short hard money loan for 12 months, I'll pay you back then, market goes the wrong way, asset's gone. So I would say be thoughtful about how long your loan is. And for newer people, I think fixed rate is probably the way to go.
Sure. I in the residential space as a broker, I'm selling a number of properties that secured 9%, debt or 10% debt at, 6 months, 1 year, 18 months, and they're freaking out, and we're trying to sell these assets and they're usually flippers that I'm working with in these cases, in those specific situations. But I know guys that have bought multi with that type of debt, and they couldn't get out of it. They had, we had to do some stuff. We had to sell the assets for them. So yeah, it's not. You got to be careful.
Yeah,
you just got to be careful.
And just to finish my thought is floating rate is not bad. It has been amazing for the last 10 years when rates, or not 10 years, for the last few years when rates were zero. It has been by far and away the most flexible financing you can get. And there are a lot of people in the world much more experienced and smarter than I am who still to this day swear by floating rate debt because I can sell anytime. When you can't sell or you have a huge prepay, you don't want to be in that situation either. So,
but I guess it also depends on your time horizon too. So if you're a fix and flip or even on a large multifamily, you're buying a 40 unit that's been mismanaged, not managed properly. You want to go in, do your value add within 18 months, 24 months, your plan is to flip that. Great. Then floating debt is wonderful, or maybe even bridge debt or something like that. But if the plan, like most of us, certainly Larry and I believe yours, is a longer time horizon, 5 years, 7 years, 9 years.
Right.
I mean, even for me, a lot of my stuff I want to keep for 15, 20, 30 years, then not as wise
absolutely
type of financing. So the time frame, I think, is pretty important too.
100%. It's just whenever you have to, hey, it's an 18-month hold. You got to be able to hold longer, because if you look at multifamily over the last 100 years and you look at the average price, per unit sale, I believe, and don't quote me, but over a 10-year period, the average price per door has gone up. So obviously people lose money in investing in real estate, but if you can hold long enough, most likely you'll be okay. So even if your plan is to sell in 18 months, get a 36-month loan if you can. Don't match it perfectly because things happen in real estate, right? You think we're gonna be able to push rents in the first month and it doesn't happen, or second. Real estate takes a long time. It takes, we own a bunch of different sizes of properties, but it takes a couple years to really get things up and running. It doesn't happen overnight. So give yourself a little bit of cushion on the financing. Even if you think it's 18 months, get 36-month loan. Give yourself a little bit of wiggle room.
I'll give you an example of that. We're doing a ground up construction on a single family home right now, and we took 18 months, interest only fixed, but it converts to a perm for 30 or 28 after that, right? Whatever it is. So fortunately we fixed it at that moment, which was amazing, right? When we could have floated that, and that would have been a disaster. That would have been sell the asset disaster, right? So for sure, without a question. But we're still bumping up against this 18-month window of, hey, you got to have the CEO in 18 months because of delays on materials and all these other things. And so we're gonna squeak this one out. We're real close. I think our deadline's the end of January. We'll probably get it done. We probably won't have to go back to the bank and say, please, give us a couple more months to get the CO. But yeah, you don't want to match it. And we thought we were going to get this done in 12 months. But
so you gave yourself some cushion. But as you know, I make a joke, and it's not 100% accurate, but I say double the timeline, double the budget. Yeah. And if your deal doesn't work, then you need to think about it. But in construction, it is a bat as
Well, the industry term is stress testing. When you're underwriting, you need to stress test, meaning you plug in all these numbers that you're calling them realistic, but they may be rosy numbers and assumptions that you have, but you need to be plugging in some different assumptions if interest rates go up by 3% or 4% in a year and a half like they've done, or whatever it is, or vacancies go from 3% to 10%. If we have a recession coming here, and we don't know if we will or not, but let's say it does come in a year and a half, we might go back to high vacancy rates like there was 12, 13 years ago. So, and there's all kinds of different numbers that you're plugging into your underwriting, but you need to stress test it so that you were fortunate enough to do that 18-month time frame as opposed to 12, whether you knew it or not. Yeah. At the time, what you were going to run up against, but at least you made the right move. So
I'm a newbie at ground up, so that this was like let's just like be as conservative as possible.
Smart.
But the difficult part about being conservative is if you're too conservative, you'll never
do a
anything,
deal,
right? So it's a very difficult. How do I, be optimistic and proactive and do deals while also being conservative? And it's a very fine line, and it's an art, and it's not perfect. But I think, again, for me, is be conservative with your leverage. Because that is usually what the issues are.
It's easier to do that when you're syndicating than when you're using your own money. So we've historically levered at 75% if we can get it. Yep. 65 to 75 has been the range, and with our own money that's been efficient, especially in when we're trying to grow. And we've refied out along the way, like we refied everything in the 2020, 2021 range. Right. So everything's low, but we were able to cash out and go do more deals in that moment too. And so we just continue to max that out, which is a little risky, right? A little bit. But again, if you're doing really good deals and you're buying pretty cheap assets and you're doing that value add, like that's what we do as well, and so does Jerron, then hopefully you're in a very good place if you can execute well.
Absolutely,
right? Yeah.
Especially like you said, if it's your own money, you only have so much, right?
Yeah.
So 75% makes a huge difference versus 65%, because then you might not be able to do your next deal because you don't have the equity to do it. So you're absolutely right. There's no perfect way to do it. I just warn people of leverage levels.
But you were saying you do 50 to 60 loan to cost, right?
Yeah.
So you're rolling in the CapEx into that math,
Correct.
right?
Yeah.
So I would argue we probably do the same thing then, right? Because I'm saying 75% of purchase, and then I might do another $1 million in CapEx on the
cash.
Yeah, of cash
Right.
on the
Funding
rehab
yourself.
that I'm funding myself.
Correct.
So that makes the math probably drop closer to the 60,
Exactly.
50 range.
Exactly. Yeah, that's how we've done it historically, is get 65% of purchase price, and then the CapEx and renovations are out of cash. So it brings you down to, as you mentioned, that 60 to 50% of cost. It's not the most efficient use, right? A lot of lenders will fund those CapEx dollars for you, and that cost of capital is going to be cheaper than your equity. But again, it's a balancing act of how much leverage do you want? What can your lender do? Some lenders don't do future funding, some do. So you kind of have to take what the market gives you. But I would rather do all cash deals if I can than 90% leverage all day long, even if the returns are, lower. Levered returns are lower because obviously you have less debt. But the worst thing you can do is in this business is take people's money and then lose it.
Yeah.
Right? That's rule number one. Warren Buffett: never
Yeah.
lose money.
Yeah.
And second rule is never forget rule number one. So if I have to bring the levered returns down a little bit to have more of a cushion, that's important, because as we've all seen, you just never know what the market can do. It changes very rapidly, and you don't want to be caught in a bad position.
I was also going to comment on your comment around being too conservative. You never do a deal. Like right now, we're sitting here, 2023. We all look really smart for buying assets in. I was buying from 2011 and so were you, till 2021-ish is the last big purchase I did. And at that moment in time, they weren't like home runs, right? It only became home runs after we executed. So there's like that, it looks like we were conservative in the purchase, but at that specific moment in time, you were more like, this is tight. This is a little tough.
Hyperventilating, as you're signing on the dotted line.
Totally.
Is this really going to work out? Is my underwriting correct? And then, 2 years forward, you look backwards and like, oh my God,
we're geniuses.
I underpaid for this. Wow, I stole this deal.
Should have bought all of them. Yeah.
Well, exactly.
Yeah. And then on top of that, I think the way you get out of that, at least, and my business partner's very, very good at it, sometimes to an annoying level, is he's just. And he sits in New York, so he has to feel like the numbers on the page really have supporting evidence to be there. So he's just like over diligent with, how did we get to this number? You said X. Like, because a lot of people will be like, oh, landscaping's X. Okay, did we bring the landscaper out there that works for us? Did he actually get that price? okay, you said, and we go literally line by line by line until you're like exhausted this thing and you really actually know the answer instead of you think you know the answer. And a lot of people, that's where they stop. They're like, oh, either the OM said this is what it is, or he's doing it over here on this other asset for me, and so he should be able to do the same thing. But then you bring him over to this new asset you're buying, and it's 2x the cost of whatever line item that is, and you're like, why? And now you're having this deep discussion about why it's 2x the cost. So if you're like that level of underwriting, then I think that's where being conservative is really important. Right.
Yeah, I think it's so important to do that. Every single assumption you make, you have to think about and you have to talk about. And did we bid this out? Who did we bid it out to? Are they going to be in the business forever? Right? Is my landscaper moving to New York? Or, is this a real bid? Or is this just a guy who wants my business because he knows that I'm going to sell his mom's house or something like that? Right. So you have to take all these things into account. I think when you talk about buying, maybe the most important thing besides staying power and be able to stay in things when the water's a little rocky is thinking about when you're investing, right? So obviously 2008, 2009, we had the great financial crisis. You usually bull runs last 10 years or so, and then there's a correction. So you could have said, in hindsight, it's 2020, but okay, it's 10, 11, 12, 13. We're probably relatively young in this run, right? So even if I think this deal's tight, I think that we still have some more room to run. So even just through market appreciation or whatever, I think I'll be okay. And then when you're investing, and call it 2022, and this is what you heard a lot of people saying, hey, I'm not investing right now because I think we're at the peak. And people who bought in 21, when everyone thought we were at the peak and sold in 22, made a ton of money, right? And they were squeaking out those last few months or whatever of the real. So I think zooming out and saying, where are we? All right, we're 2023. Rates have gone up a lot. They could go up more. We don't really know. You're never going to know exactly where you are. But once we start to get a sense from the Fed that rates are not going to continue to go up and that there's, market hates uncertainty, whether that's in real estate, stock market, fixed income, people hate uncertainty. Once there's something from the Fed or an election happens or where there's some certainty, there's always uncertainty. I think that there will be a pouring of investors in capital into investments, whether that in all asset classes, in all markets. But I think that trying to time it's impossible, but just having that thought about, okay, where are we? When was the last recession? All right, we're now in year whatever, year 14 almost, 15. All right, historically, if you look, history doesn't always repeat, but it rhymes. We're probably going to go into some sort of correction. So maybe I should wait. Or maybe I should not, so that is maybe the most important thing is not necessarily, hey, I paid $150 a door, $148 a door. That doesn't matter. It's more, when did you invest and where are you in like the general cycle, the financial cycle is probably the most important thing you can do in investing.
That's why investing just consistent, like you're saying, you're like, hey, I'm going to be doing this for a long time. We say that too. We're like, I'm going to be doing this forever. I'm here forever. Let's build good relationships. Let's invest like that from that perspective. And you're basically dollar cost averaging in, right?
Exactly.
So exactly, it's good because now you're taking the wins and maybe you invest a little high in some cases, but overall it's good.
Yeah, exactly.
As long as the deal cash flows, that's really important. As long as you don't have to have capital calls and you have 4 partners in a deal or 3 partners and you're saying, hey, we now are up to 10, 12% vacancy. We're in the middle of a recession and there's leaks in the roof and we got to put a new roof on. Hey, we each need to, put in $10,000 here for our quadplex. That's not fun. No one wants that. So yeah, just putting the pieces together, I agree completely that you need to have a macroeconomic perspective on your micro investing, on your targets and your portfolio, and also, what Larry's saying there too is, you can dollar cost average, and absolutely you can keep investing even through the early parts of a recession, even if prices fall 10% or 15%, as long as your property's cash flowing, if you're going to be holding that asset for 5, 7, 10 years.
Yeah, I think a couple other things. One is one thing that I really had never thought about before I started investing down here is how big and how much of a working capital account do you need, right? It's so easy to say, property's for sale for $1 million. I'm going to get 75% leverage. I need $250,000. That's it. I'm good. No, there's a lot of other things, right? There are closing costs of the financing. There are acquisition closing costs. Do a survey, pay your attorney. And then on top of that, and most importantly, is having a working capital account. I mean, you talk to some of these bigger guys, the Bill Gates of the world, they'll tell you they want 2 years, like if revenue shut down, they want 2 years, maybe more, depending on who it is, of cash in the bank to pay payroll, to pay office rents. So it's really something important that I know when I first started, I didn't even really think about, but how much cash do I want to have in the bank? Now, the more cash you have, the more drag on the returns you have, right? Because you have more money in. So
slower your growth is too. If you're in like our situation where we're like, let's get to a certain level. It's hard to grow when you like just stash 2 years of cash.
And it's just sitting in a bank account doing nothing. Yeah. So it depends on the execution, but I typically want to have 5 to 6 months minimum of my operating expenses, real estate taxes, insurance, utilities, general administrative reserves, management fee, et cetera, landscaping, pest control, plus my debt service. So my total burn, for at least 5 or 6 months. And that can be a big number for these larger deals. It can be, $500,000 of cash that's just sitting there doing nothing. But in a scenario where everyone stops paying rent during COVID or something, you may say, I wish I had more. And so it's really important to make sure that you have enough money in the bank to weather a storm, even though it's, I could have used that money somewhere else on a different deal. You can't run out of cash.
Especially when you are a steward of other people's money. Like that's super, for me and Connor, my partner, we can call each other up and be like, no, shit, we need to deploy another 100K into this. And it's just like, all right, cut a check for 50. I'll cut a check for 50. We'll get it done. It's like easy. Alternatively, when you have other people's money, that's not a call you want to make.
Yeah. And it's a difficult balance because obviously you and your investors want distributions, right? We want distributions, especially in a time like today where, hey, we might be going into a recession. I want some cash. Let's bring some cash out of here. But so it's difficult to have the discipline to keep the cash. That being said, you're never fully protected. You could have you could have 12 months, you could have 18 months. Things can happen, right? Something could happen to the building and your insurance doesn't cover it. And now you have to write a check for a new roof or a hurricane.
And a war with Iran. I mean,
you're never fully protected, which is scary.
Yeah. Well, you're putting roofs on all your buildings. I'm assuming that probably is because insurance is pushing you in that direction.
Correct.
So same thing. I mean, we have assets that we can't get windstorm coverage on right now, and the answer was, okay, we'll replace all the roofs and you can get it. Mm-hmm. It's like, okay, we're doing the math, and it's just like, holy smokes, like this is a substantial amount of money to replace all these roofs. They're working. There's no leaks in them, but we got to do it. So yeah, how are you handling? So how has the insurance been for you? Yeah.
My favorite topic.
Same.
Yeah. I think insurance across the country has been very difficult for people. I think you talk to people in New York City and California, in the middle of the country, insurance has gotten more expensive. I think primarily due to the reinsurance market, which when interest rates were zero, insurance was an interesting place to put money because there weren't a ton of other options. Now that you can get 5-6%, in the bank, fully liquid, you can get it at any time. Obviously, in order to you have to think about risk-adjusted returns when investing. So if you think about the risk-adjusted return on getting 5 or 6% in JP Morgan, Bank of America, you're going to get that money, right? That's a huge bank. What premium do you have to get paid to insure, or to reinsure an insurer who's insuring real estate in Florida or anywhere? It's going to go up, right? You're going to demand a higher return for that. So that's one of the many reasons you've seen insurance premiums skyrocket across the country. Now, I would argue that South Florida is probably seen it the worst. I think California and areas where there are wildfires are having trouble. I think places, where the hurricanes hit more in the Panhandle have had a lot of issues. I think places in Texas. But it has been very, very challenging. Thank God for the Florida-backed Citizens Insurance, which has been extremely
a
lifesaver for not only people. I mean, people in their homes. State Farm, I think, said that we're not insuring Florida homes anymore, and these people Progressive, and Florida is doing a from what I understand, is doing a good job of trying to make it a more attractive place for insurers and reinsurers to insure. And I know companies like Slide and other companies are coming in and trying to backfill some of these citizens policies. There were a lot of issues where people were making claims. Hey, I see on the roof, you have a stick on the roof, and a guy would come and we can make a claim. And there was a lot of fraudulent activity. I don't think that's the main driver, but Florida has tightened the clamp on that. Mm-hmm. So I think that, and you talk to the insurance experts who know a lot more than any of us, they're hopeful that the market will kind of come back. I don't know to what level, but it can't continue at the level it's at now. And, we'll see. But it's absolutely, if you think about what you have to consider when investing, you have a lot of things. You have interest rates, you have population growth, or just talking about operations of a building. Insurance by far and away has affected, I think, arguably in South Florida, more owners than any other line item, including debt service if you have a floating rate loan. Debatable, but I mean, some people are like, hey, I was paying $1,000 a door in insurance premium. Now I'm paying $3,500. And now, if I look at my debt service ratio covenants with my bank, I'm now in default, but I can't bind coverage except for $3,500. So I think and hope. The good thing is, what I tell myself is that we're in Florida, which is a very pro-business state, and they want Florida, the governor and people within Florida want Florida to be a great place to come and do business. Okay. They have the Citizens Program, which was a great thing that they put into place, I think, in the 80s or so. They're going to figure out a solution to this, whether that's more citizens or more state-backed insurance or providing some sort of backstop for these insurers or reinsurers. They're going to figure it out. I'm confident that Florida can do it. I don't know if I would say that if I was in another state, that they would figure it out. So,
and it's not going to be figured out tomorrow. Even the legislation they passed to clamp down on the fraudulent litigation on the roof, litigation and things like that, that's going to take time. But I am hearing, I was just speaking with an agent yesterday who he has an Allstate brokerage, and he places a lot of his clients into Citizens because it's just the most competitive program in many cases. But he said, I think Citizens, he said recently, had about 1.3 million policies they were insuring in Florida, and it's now dropping to, I think he said, somewhere between 1 million and 1.1. So it's moving in the right direction.
Yeah.
As long as another competitive insurance company is within 20% of the Citizens price, then they drop you from Citizens and they transfer you to the next competitive private insurance. So the only issue, though, with Citizens for commercial and multifamily deals is there's a cap. I don't know offhand, is it 2 million or
I don't know either.
I forget the exact amount, but there's a cap. So if you're dealing with 100 units or 200 units, it's nearly impossible to get Citizens insurance unless maybe you have different portfolio numbers that you've aggregated those portfolios into one asset with one loan. Then I've heard there's some ability to get in Citizens. But yes, from a high level, insurance, I agree with you, has been the real pain point for investors over the last year. Yeah,
I'm selling people's homes because they can't get insurance and they can't spend the money to fix the roof or whatever they need, so they opt to sell the house and move somewhere else.
You're seeing people in the commercial space start to be a lot more thoughtful about it and how can we get around it. So, today with rates being so high, you're seeing a lot of deals getting done with either seller financing, where the seller holds paper, or assumable financing. A lot of times the seller financing has attractive insurance requirements, or you can work with the seller to have attractive insurance requirements.
Like super high deductibles, for example.
Or just, hey, I don't care that you insure this for business interruption insurance. I don't care that you would insure this
or even for wind sometimes.
Right, yeah. And you can say that, and that can be part of the negotiation. Hey, I care less about the interest rate. I care more about, hey, can I only insure this for $200 a foot in replacement cost? And so on top of that, there are third-party property managers that have insurance umbrella policies as well. So I've heard of people who have been with one third-party property manager and gone to another because they have an insurance platform that you can tap into. By using them as the third-party property manager, then you can go into theirs, and they have a policy of properties across the country. So now you diversify the risk a little bit. So there are ways that people are being, and then obviously if you can buy all cash, great, then you don't have to do it. But there are ways that people are being creative. like anything, any issue, you're going to find entrepreneurs or people who are going to help solve the issue. You're seeing a lot of that, especially in seller financing, assumable financing, buying cash, or using your third-party manager too for their insurance policies.
There's a bank here that will lend and not require wind. Mm-hmm. So I don't remember the name off the top of my head, but there is one.
Yeah,
we've talked about it.
There are, I believe, a couple
Yep.
that are doing that. I think as an owner, you have to also think about, okay, you're giving up something, right, for a price.
The rate's higher is what I've experienced when kind of pricing things out, or it feels a little higher. I haven't done a deal with them, so I can't speak to that exactly.
Yeah.
But
So what am I giving up? What exposure do I now have? What are the chances that's going to happen? If it does happen, what do I do? Or if I do get the insurance, what's my deductible? Okay, I have a 6-figure deductible. And then, you got to think about how much cash do I need? It's not just a wave wind. That's great. It's a lower premium for me. You got to make sure you have, you're probably going to have now more cash you want in your pocket just in case something happens. So it's a lot of things you have to think about when doing this insurance stuff.
And when it comes back to underwriting, this goes back to a point you made earlier, like, did we bid this out properly? It's like one data point isn't the answer. Like 3 bids, are they all consistent? Okay. Because like to your point, that one guy that's super cheap could disappear tomorrow, right? But same situation with insurance. Like you go with this lender that doesn't require wind, so now all of a sudden the deal looks better. But at some point, probably in the future, you're going to need to get that coverage again with another bank if you refinance or something. Or when you sell it, the new underwriting is going to include wind, right? So it needs to work with the wind coverage at some reasonable number. And then on top of that, what I've experienced lately in underwriting a few deals is what's making it hard for me to commit to a specific deal. So is the insurance is not certain until you really get through diligence and really get it bid out. Like really,
and your
not
money
an insurance
is non-refundable most likely.
Right, exactly. So the ship has sailed. So like you're in the deal at that point usually. So like I'm talking to some of these insurance guys and they're providing me insurance indications. And a lot of people, maybe new people in the business here, might not understand. An insurance indication is them guessing at what the heck they think the insurance price is. Insurance indications from the brokers and everyone else is, I don't know, worthless to me probably, almost. It's like, cool, because I sent an email to one insurance guy and I'm just like, hey, see, you're quoting $1,750 a door. All my policies are $2,500 to $3,500 a door on all my other 100 units. How'd you come up with this? Well, we can't bid flood for this reason, so that's not included. Okay, all right, right there. And then I was like, well, how did you come up with 18? They're like, well, and they're just like, from all our experience and da-da-da-da, this is where we think it's going to be. It could be higher. We really don't know, So like, how do I underwrite that deal? Do I underwrite at $3,500 or whatever the number is? I think I was underwriting that at $2,500 a door because of certain things. So I'm underwriting at $2,500 a door. I don't going to $3,500 a door changes the deal dramatically. Like it's like, so now I'm underwriting at $2,500, but I need to see my return at, I don't know, I need a 10 yield on cost or something, right? To like just to buffer that nonsense.
And it's not only what it is today. You have to underwrite what it's going to be going forward, right?
Sure.
So in a deal I looked at recently, I was budgeting 10% increases a year in my insurance premium, which, by the way, could be too light.
Yeah.
Hopefully it's too heavy, but it could be too light. So you run that through a discounted cash flow of a 5-year hold of 10 to 15% push an insurance premium a year. How many deals make sense? Or you're so far off on the numbers. So that is, I think, by far and away the biggest question mark. I think obviously interest rates are scary, but you can lock in a 7% rate. At least it's 7 and you lock
exactly.
in.
You know
but
that.
Insurance, you really it's a total guessing game, and I just hope something happens. And by the way, to the broker's defense, they don't even know.
They can't.
So they're doing their best for us and giving us an indication, but they'll tell you, we don't know.
Exactly.
So how are you supposed to underwrite, and how are you supposed to, have a deposit go non-refundable when you don't even know if it's a 6 cap or an 8 cap or a 4 cap? I mean,
that goes back to being patient. Like that level of uncertainty just doesn't work. It just doesn't. If it's going to materially change the deal, unless you get it for cheap, that's fine. And that's the bid they get, the offer they get, right?
Which in today's day and age, changing topics a little bit, is the difference between buyers and sellers, right? So for buyers, all right, my insurance premium is a total question mark. I get a budget there for 3,500 plus maybe 10% a year. And I don't know what's happening in the world. Interest rates have changed dramatically. And sellers are saying, well, the guy next door sold for this amount per unit. That's what I want. And they don't understand that it's a totally different market. So they're like, all right, well, we're going to wait. We're going to hold. And the buyer's like, okay, well, this is my number. And they don't like the number. So in order to buy, you have to have sellers. And today, most people would not sell into this market unless they had to, unless they had a maturing loan, unless they had a liquidity need personally. Their partnership just wants out. I've heard of people leaving Florida. I can't do the insurance premiums. I'm done. I'm not investing here anymore. Now, I think that the one of the most important things in investing in real estate is population growth, regardless of your asset class. You want people moving to the area that you're in. So I think that we have a really great tailwind in that. That being said, that can change, right? New York City, 10 years ago, everyone was moving to New York City. These things change. The Sun Belt has been really hot. Will that continue? Will it go west? Will it go north? I don't know. But the good thing is today we have a lot of population growth, but it's there's not a lot of deals to buy. I think if you look at investment sales across South Florida over year, they're down 60 to 70%. And so it'll be interesting to see what breaks. I think you'll have some loan maturities that'll come up that people will have to sell or they'll have to refinance with maybe a cash in refi, or they'll have to get preferred equity. So I think that we'll see, but I think that we're at the start of something. I don't know if it's, going to go skyrocket down. I think it could also go skyrocket up. If the Fed says we're cutting rates and it's go time, there's a lot of dry powder and people sitting with money in their pocket, foaming at the mouth to do deals. And so it could go either way. I'm not going to guess. I'm going to look at the deal today and say, is this attractive to me today? If insurance goes up 15% next year, what does that look like? And make as conservative assumptions as possible, which is going to hit the seller on the purchase price, right? Because now there's less cash coming out of it. But it's an interesting time. You have to be very, very thoughtful and selective.
You kind of commented on this, but what does your day look like now? You're underwriting deals, aggressively making offers. Where are you at?
Aggressively making offers. No. I'd say most of the people you talk to who are owner operators today are telling you that they're really focused on their operation themselves. We've got some, projects that we want to focus in on. We haven't done a great job with this. We're going through every line item on our expenses. Who's our plumber? Who's our electrician? And really saying, what are we paying for? And really digging into looking inside, which when the market's really good, you don't have as much time to do because you're trying to find new deals. So I think it's a really good time for operators to look inside at themselves and say, how are we operating? What can we do better? So that's what I'm spending a lot of my time on. Also spending time on trying to build capital relationships that say, hey, once this thing lifts or once rates change, we want to be ready to go. Here's what we have. And then also still continuing to have those broker conversations, as well as other, people within the market, to just keep me top of mind or keep us top of mind. All it takes is for you to call a broker and he's like, you know what, actually, I might have a deal for you. I didn't even think about you for this. And then you get it. So,
yeah.
That's...
If you don't talk to them for 4 or 5 months, they forget about you after a month.
Exactly. Exactly. So you got to stay top of mind. CRM, which I don't have, which I should, is really powerful tool. Reminders, hey, reach out to this person. So I would say it's overseeing the day-to-day at our properties and what's going on there. I would say there's been a bit of a change, too, in... on the top line side, on the rental side. So when rents were going up 20%, a year, and one guy left, you're getting 1,500, then 1,525, 1,550, 1,575, 1,600. You're like, I don't care if someone leaves because the next guy's paying me more than the last guy. Today, that's not the case. And, when you look at deals, a lot of times you see this, loss to lease, meaning the rent's really 1,500, but this guy's only getting 1,300. Because the market's moved so much in the last year, they haven't been able to keep up with it, or they like the tenant, they don't want to push. Today, I'm seeing gain to lease, meaning it's 1,500 they signed last year, but the market today is really 1,400. So taking, the old way to do is you take the rent roll, you say, what are the highest rents they're getting for every unit? For the 1 bedrooms, highest they're getting is $1,400.
Set that number.
2 bedroom is $2,000. All right, so 14 market for obviously look at rent comps as well. Today, the question is, when were those leases signed? What's the security deposit on those leases? What are the other? And you've got to really stress, because it's not anymore in the bull run that we were in, where you can assume that the highest rent they got is actually market. You actually have to see what's the lowest rent they have. Why is that the lowest rent? Is that really market? And it's been a totally different change. So instead of, we never want vacancy, but if someone leaves, we're okay with it. Today, I want to limit vacancy as much as I can. Hey, how can we work with you on this? I know we went up $25 on a $2,000 lease, so not much. Can you do 10? Do we need to stay flat? On a new lease that is now vacant, do we need to offer a free month? Sometimes that happens to fill them up.
Are you feeling that in your portfolio right now? You're absolutely feeling like, hey, I'm feeling it softening. In most cases, I'm still getting pretty good rent numbers, if not better than I was still. I think it's asset specific, asset class specific. So what asset classes do you typically own? Like, what does your stuff look like?
Yeah, it's a good question. It's really built between 1980 and 2010 is kind of the majority of the stuff that we own.
Pretty good neighborhoods?
Yeah. That's a really important thing for us, is being in strong demographic areas. I really want median income to be, call it 80,000 plus.
Okay.
Which, for certain areas, if you're in Greenwich, Connecticut, that's very, low income. If you're here, it's pretty high. National average is in the 70s, I believe. In Florida, you'll see sometimes 40s, 50s, depending on where you are.
That's where Jerron and I own.
Right. Nothing wrong with that, by the way. But, we own primarily in, call it the Palm Beach Gardens and Jupiter. And so kind of nicer areas. And I think to answer your question, are we seeing the pain? I would say it depends on the asset. It depends how much vacancy we have. I would say it's taking us longer to rent, for sure.
Yes.
Even if it's the same number. Before something goes vacant, we tell our third-party property manager, we have an application that's quality. You obviously get a lot of not quality applications. So we get one 24 hours, 48 hours. Now it could take a week, 2 weeks, 3 weeks. And now I'm saying, hey, do we need to lower the rent a little bit to get someone in? Obviously, you have smaller properties. We have a 14-unit property, and if 3 units go vacant, 21-ish% vacancy, I want those things rented up. So I'm maybe going to come down a little bit, maybe offer a free month. So what I'll tell you, to your point, it's definitely softening. It feels like it's maybe a little bit stronger now than it was, call it 6 months ago, but it feels like plateaued, and it's definitely just taking longer to rent than it used to, which, like I said, in business, things are great. Things are not great. They're never as good or as bad as they seem, but definitely taking longer for us to fill up units.
How do you define longer? Sorry, I keep cutting
you off. I think it's truly, we would get an application in 48 hours, and now it might take, at the slowest, we might have to have a unit set for a month, which we don't want to do. But we really rarely have something set for 2 months. But at the same time, I don't want to, if I have a 14-unit building and rents are $2,300, I don't want to sign a lease for $2,150, because now everyone else sees that I signed a lease for $2,150. They're upset. Not only that, if I do sell or refi, they're going to say, oh, this was the most recent lease you signed and it was $2,150. We're going to mark that. So you have to be very careful with that, because you can really, if there's a capital event coming, a refi or a sale, you can really hurt yourself. Hey, it's only $100 a month, but now that becomes the market, which you times by 14 times 12, 5% vacancy, 60% margin, whatever. And now whatever your cap rate is, now you've maybe gotten rid of millions of dollars of value by taking $50 to $100 less. So I think there are ways to kind of play with it. You can require a lower security deposit. So let's say you're doing first last security. Say, hey, how about now we do first and 1.5 security? So, half a month less of total money they have to come up with. Maybe we offer a free month rent. So we keep the face rent the same, so that if in the future we sell a refi, we have that face rent that shows well. So there are strings that you can pull, but we're definitely having to start to pull some of those to be more thoughtful about how we get rents and how quickly.
That's clever. clever. And also you keep the recorded, say it's on the MLS or wherever it's at, you keep that recorded rent at $2,300 as well on the MLS. So comps continue to sit at that number.
We're also seeing some of our tenants, and not a lot, we just saw this the other day, but that instead of signing, we do annual leases. But instead of signing annual leases, they say, hey, can we sign month to month? We've got something going on. We might need to move. And it's not a lot, but it's just something to be thoughtful of. If that people are a little bit less confident maybe in their existing jobs. Now, unemployment's still low, especially here in Florida. But people are a little bit more or less confident in what's going on. Obviously, credit card debt is higher than it's been in a while. Some companies are laying off. I think there's an election coming up. There's a lot of uncertainty, and people are getting a little bit more concerned, so they're a little less likely to maybe sign a 12 or longer month lease. So that's something we're seeing too.
And to that point, one thing I've learned certainly in the last 6 months as things have softened a little bit is Larry and I share the same property manager. I make sure to tell him, hey, give me feedback. So if I'm like raised rent, like maybe this tenant was in a unit for 3 years and maybe they left and, I want to bump it up, or it could be a prospective tenant that's trying to come in, or even a tenant that I'm trying to raise their rent, on the annual lease renewal. If they give pushback, sometimes I really need to listen to that now. I may not have listened to it so much a year ago or a year and a half ago when rents were going up 20% per year. Because, like you said, if I have to turn the unit, not the end of the world because, I'm going to raise the rent by 20%. Or sometimes I keep rents just a little lower than market, especially because most of my units I don't do refining on. I've got fixed 30-year debt on a lot of them, not all of my properties. But if they push back a little bit, at this point, I want to keep them in the property. Don't want those vacancies, just like you said. So let's say rent's $1,800 and I want $1,950, and they say, well, hey, I can't really do that. Can the landlord do $1,875? And our property manager will come back and ask me. Normally I'll say yes, or maybe I'll say, hey, ask them if they can do $1,895 or something like that, and we agree upon a number. I'd much rather that than lose a tenant over $55 or $65.
Could not agree more. At the same time, I think it's also important to remember that your tenants expect you to increase the rent in some capacity, right? And so I think that if you stay flat or I'm only going, that leads to them on the next renewal, and you can get 2-3 years down the road, you can be very far behind. You could have lost $200, $300 a month because every renewal you give in to their request. Now, I'm not saying that you shouldn't, and in today's day and age, I think I'm doing the same thing. Hey, where can we get these guys comfortable? You don't want vacancy. Obviously, you want to keep these people in their homes, but you just have to be thoughtful about it. And it's a constant battle. But if you get behind, it can be very difficult to. You'll probably eventually have to have a vacancy to get up because the next renewal, if rents keep going up, is going to be too much for one person to absorb at once. So it's a balancing act.
Another thing I sometimes have our property manager do is if I'm going to compromise on a rent increase, I'll make sure he gives them a quick little speech of, hey, the landlord's going to accommodate you here, but he's doing this because you're not a regular complainer about issues in the property. So that kind of, it's the psychology. You're shifting their mindset. Well, hey, maybe if this little rinky-dink thing is broken, I'm not going to call immediately and ask for it to be fixed every single time that there's something wrong. Or, hey, maybe I'll actually plunge my own toilet rather than calling the handyman to do it for me, that kind of stuff. So maybe it'll save you a few bucks in the long run to send over your handyman for $150 to whatever, plunge a toilet or snake a toilet because maybe their brother has a snake or something that they can unclog the drain. So
I think
they'll use Drano.
Yeah, obviously the opposite side of that is a lot of tenants
deferred
don't tell
maintenance.
you.
Of course you don't want that.
We have no issues, no problem. And then 3 years later they leave and you're like,
it's trashed.
It's trashed.
The mold was growing.
There's
in the
plumbing
kitchen,
issues.
Right,
there's electrical issues. There's mold. So I think I agree with you. And it's a balancing act. But I think it's better to deal with things earlier and as they come than all at once. But you got to deal with it at some point, right? Like whether you look at your P&L and, oh, wow, it's been great. And then one month you get hit. And it's like, all right, well, if I had been going every single month, I think you shake out at the same place.
What I'm learning too is we were talking about the fact that you have a project manager that's full-time for you. We don't. And so one of the concerns that he and I share is, we have some smaller assets in different areas of the county, and we share the same property manager, but that property manager uses third-party vendors to take care of these things. That starts to add up. Every single time you send a plumber over for a tiny little issue, again, $150, cha-ching. Someone comes over to, I don't know, fix a cabinet door, another, $250, cha-ching. If you have a project manager that's handling some of these rinky-dink issues, absolutely, I'd be much more likely to not be to be more concerned about deferred maintenance and them not telling you about a small issue that could later turn into a big issue. Whereas for us, not that we want deferred maintenance, but at the same time, we really need to watch out for our costs and our third-party vendor costs for handymen to come over. In some ways, another issue we have is on our turns on our properties, because we're using third-party vendors that are coming in, and our property manager will likely get at least 2 different competitive quotes, but it's so expensive. It's still, for a basic turn, we're looking at around $6,000 per turn for painting and putting in new fans and some basics. And then for complete gut jobs where you're ripping out flooring and putting in new flooring and new cabinets, and you're talking $20,000 to $25,000. Whereas if you have a full-time project manager that's doing a lot of it or subbing out just smaller parts of that project, I'm sure your turns are much more reasonable than ours are. So it's kind of back to the project manager position full-time. That is one of the pros of having that.
Also, some of his assets are much newer than our assets.
That is true, too. A lot of ours are built in the 70s, and
we don't have lights in any of the rooms, in the ceilings. So we're in a lot of cases we're doing all that infrastructure work. So that's part of it. And I'm hopeful that as we continue to move up the quality of the asset, from putting in the LED lights, putting in fans in the bedrooms, putting in microwaves. There's no microwaves in these units. There's no dishwashers. We don't put dishwashers in our units anyway, but there's no dishwashers. I don't know. Do you have dishwashers in your apartments?
We do, yeah. So, but it's always a question of whether you put it in or not.
I agree.
We are in, call them nicer areas of Palm Beach County, and I think the tenant today that we rented out to may not use it. They may not. Some people just don't use dishwasher. To each his own. I use them. But I always think about, if I want to continue to push this rent and I want to continue to get a higher quality renter, the highest quality renter is going to want in-unit washer, dryer. They're going to want dishwasher. This tenant may not. So I could save a lot of money by not putting them in, because a lot of the existing tenants that we get don't use them. So I'm just spending for no reason. But at the same time, when that renewal comes up and they look around, they say, well, I've got a washer dryer, I've got a dishwasher, I've got, or someone comes over, their friend's like, wow, look at this dishwasher. Like, all it takes is one thing like that, or the area changes and Amazon builds a new center next door, and now you have it having to rip out cabinets and replumb. And I'd rather do it on a turn right away and spend the money immediately than have to spend it in year 3 or year 4, year 5, where you really want to be kind of done.
I think it your neighborhoods, not to say that all of our neighborhoods are bad, right? No. But some of our neighborhoods, I have dishwashers in them, and then others, we absolutely won't put them in. Part of the issue is they don't use them, and so a year, 2 years later, you got to replace the dishwasher anyway, because the seals are all, or you got to fix all these things on a dishwasher. Mm-hmm. Because they just don't use them. The seals go bad because it's been dry rotted and stuff like that. So we stopped doing that in a lot of the apartments that we have. But the other core things, like you have washer dryers in all your units. Okay, so most of that, a lot of the assets we buy don't have washer. We got to put that infrastructure in. So again, that goes back. I mean, I think I'm spending out of that $25,000. I mean, $5,000 of that is moving. Trying to find a place to put a washer dryer, moving water heater, putting tankless water heater in the ceiling, rebuilding the walls so you can slide in one, plumbing out, taking out vanities, getting behind the wall, doing all the plumbing.
Yep.
It's like, I mean, that's 5Gs.
No question. Yeah, we do the same thing. Not all of our properties have.
But you put them in.
But we put them in.
It's washer dryer, I think, is important.
If there's one thing that people want, obviously besides a bathroom and a kitchen, washer dryer, I mean, that really ups the level of what you can push for rents, what kind of tenant you get.
Do you just provide the hookups, or do you actually provide the washer and dryer?
Provide the units.
You provide it, and you don't rent the washer dryer to them as like added. Okay.
No, and not to get all of super tax focused now, but by buying these, these have a shelf life too, right? A lot of times when we buy appliances or whatever, we'll do, if we spend money at a property, we'll do not only a cost segregation study to advance a lot of the depreciation on our buy, but as we spend money, we'll do cost segregations too, right? So we'll spend a bunch of money on roofs this year. We'll do cost segregations on those roofs. Normally that'd be a 27.5-year straight line depreciation, but now maybe the shingles, those are 30-year, but maybe the wood is only 5-year. And so, you're able to, so buying appliances, one of those things, the shelf life is shorter. So if you spend, I don't know, a couple $100,000 on appliances, you might be able to, depreciate that in the first year, which makes a big difference to your investors who are very tax conscious. So that's another piece to think about too. And by the way, if you're getting rid of appliances and you, donate them, that's a donation, right? If you give them somewhere, and obviously donations you can write off. So there are things to be thoughtful about when it comes to spending money and then getting rid of things and stuff like that.
That's a good idea. Let's transition to back to the investor structure that you have. So you mentioned on your first deal, I think you had 3 partners, and I guess that would be considered a joint venture, right? I mean, you had whatever, an LLC and 4 members to your LLC, or however you structure that. On your larger deals, have you done true syndications where you're SEC compliant and you have a general partner structure and a limited partner structure?
Yes.
So why don't you explain that to the audience maybe who don't know a whole lot about actual syndication and in layman's terms, sort of what that looks like?
Happy to. Well, syndication is just bringing in other people to help capitalize the equity portion of the deal, right? So you have a deal that costs $1 million, as I said. You get a loan for $750,000. You need $250,000 of equity. So you don't put in that $250,000 yourself. You syndicate it out to friends and family, or family offices, or high net worth, or whoever. So what we'll do is I'll put it.
And sorry to interrupt here,
please.
but just for the audience, those are going to be your limited partners, right? So they invest the money. A lot of times they get a preferred return. So the first, 7% or 6% or whatever that preferred return is would go to them. And then anything above that preferred return, then you, or if there's any other general partners, will have a certain split of everything over that preferred return. Let's say it's 70-30. The general partners are taking 30% above the preferred return for things such as finding the asset, the acquisition, the underwriting, the management, and the disposition of the asset, right?
Yes.
Okay.
So in that $1 million deal, $750,000, there's a loan you're getting from a bank or from a lender, and $250,000 is equity. So if you want to do a lot of deals or you don't have the equity, you raise from other people. You syndicate the equity. So typically in these structures, you'll either put in, and it can be as low as 5%, it could be as high as obviously all the equity or 50%, but let's use in this case scenario, you put in 10%. So $25,000, the GP or the general partner or the operator puts in 10% of the equity, so in this case $25,000, and raises $225,000 from accredited investors, meaning you have to make at least $200,000 or have a net worth of over $1 million. So this isn't just someone that you can necessarily, who doesn't make a ton of money.
22-year-old cousin, right?
It's someone
who's
who
making $50,000 a year, right? Yeah.
Someone who can actually stomach making a financial investment based on the SEC's rules. So what you would do is you would put together kind of an overview of the investment opportunity, send it to them, and then you would structure it a certain way. So as you said, let's say in this example, the operator puts in 10% and then raises $225,000, so 90%. So you would structure it something like, and you could structure them, there are a lot of different ways, but generally there is a hurdle rate, which you call the preferred return. I'll call it a hurdle rate, which is the rate of where everyone's treated, they call pari passu, or the same. So if $100 comes out of the asset as a distribution, I get 10, my partners get 90. Now that 90 can be split up, with one person, it could be 10 people, so everyone has 9%. And then, so up to a certain level, everyone is treated the same on a distribution. Above that, and it's based on, you have to get, first you get paid call it preferred return, then you get your principal back. So let's say you give out, let's say the number is 8%. So at 8%, all of us are treated the same. If I make a distribution of 15%, for me in our structure, I don't necessarily get that additional, percentage above the 8%. So the way it would be is call it 8%. And then above that, instead of 90-10, I get 20%, you get 80%. So there's an incentive for me to outperform this 8%. So that's the level that we're all treated the same. If I outperform that, I get a larger, what's called carried interest or a promoted interest in the entity. So I get a larger percentage of the cash flow. In the way that we're structured is that only happens once interest and principal is paid back. So if one quarter we give out a 20% cash on cash distribution, that doesn't mean that of that 12% over the 8, I get more of than you do. You haven't gotten your principal back. Now on a refinancing, if we refinance all the equity plus the preferred return, then I start to, or the general partner or operator starts to get a piece of that upside. So that's the way that it's structured. You can structure it a lot of different ways, but again, simply there's a, call it hurdle rate that you come up with, depends on the opportunity. If it's ground up construction, it's probably a different hurdle rate than it is if you're buying a stabilized property that was just built. And then you have what's called carried interest above that for the operator, which is an incentive to outperform that 8%. By the way, the 8% is annually. It's not just 8% of your money over however long the whole period is every year that 8% compounds. It can compound more than that as well. But that's generally the structure. So the incentives are aligned. I want to get the best possible return for you and me. And if I do that, I get an additional piece of the distribution above an agreed upon level. You can also have multiple levels. Above an 8%, first we're 90-10. Above an 8%, it's 80-20. And then if I generate higher than a 12% return annually, or IRR, internal rate of return, now I get 70-30. I get another 20% on top of my 10%. And if I make above a 15, so it can get very complex, and there are a bunch of different structures, and it can be not just return based, it can be multiple based. So if you give me $100,000 and anything above a 1.5x, I get an additional 20% of the money. So that's less about the time and more about the multiple. So not to make things too complex, but basically there's an operating partner who's boots in the ground, doing the work, overseeing, sourcing the deal, overseeing the deal, doing the asset management, doing the reporting. And then the limited partner, who's usually that 90%, is a passive investor who's writing a check and then just waiting for checks in the mail, overseeing the operator, getting the quarterly reports, but is not involved. So the reason why that operator gets the upside is because they're pouring their entire energy into this opportunity. So
what I like to call sweat equity. They're building
correct.
Sweat equity.
Correct.
Yeah.
So for a lot of people, it's a really interesting investment. The only way you really get exposure to commercial real estate for the normal person is through a REIT, a real estate investment trust that's publicly traded that you can go and buy, Avalon Bay or something like that. But these private deals, for a lot of people, are more exciting because you're not a shareholder in 10,000 shareholders. You're one of maybe 10 or 15. You really feel like you own an asset. You know the operator. So you're really you're not, you probably go and see it. Maybe when you go on a vacation, you do a tour of it. And then obviously the tax benefits are very, very large. And so if for most people, they have a regular 9-to-5 job, so they can't necessarily take advantages of the losses. But if you do a bonus segregation analysis or bonus depreciation, cost segregation, you can accelerate a lot of that depreciation. So if you're able to use losses, if you're a real estate professional in the eyes of the IRS, you can use a lot of these losses against other income. Now, I am not a tax professional, and you should speak to your CPA before using any of this.
On our channel, we actually just just recently had a webinar with cost segregation experts, so they can go to that. You can watch that video on our channel. So, it's wonderful. I'm just getting a nice significant check back from the IRS from doing this for several of the properties I purchased in the last few years, and it's great because you can use that money. You're getting money from the future and you're bringing it into the present, so back from the IRS, so that you can go ahead and reinvest that money and make money on money.
Yeah, so I just think that it's both for the operator and for the passive investor, the limited partner. These opportunities are exciting. They're interesting. It's a different alternative asset class. Usually most people, hey, 80-20 equities and fixed income. I have my 401k. Now I can, hey, interesting, I'm investing in a multifamily deal with Larry in Boca. I've heard Boca's amazing. And here's the opportunity. I get to go down and see it. I know him. I trust him. And people really like that. And, it's been a good hedge to inflation and a good tax-adjusted return. And so I would say if you're thinking about doing it, probably the most important person in your team is like a partnership attorney who knows how to structure an operating agreement. You'd have an operating agreement with you and your limited partners that governs the LLC that you guys are all investing in, who has major decision-making rights, what rights you have as an operator, what happens if something goes wrong. And so I would say if you're an operator and you want to start raising money, find a good attorney who have done these types of operating agreements, talk to him about how it should be structured, and just ask for help. And then obviously create your capital base of people that you think might be interested in these opportunities. And the most important thing in any business is reputation. So make sure that you're honest. You don't show projections that are unrealistic. You don't show rents that are unrealistic, and that you're open and available to people and you're communicative. People just want to be communicated to clearly and honestly. And, I see a lot of these opportunities that come to me. Hey, you should invest. And there's no information. We're going to spend this. Here's all the operating expenses, but they're not broken out line by line. I don't know if they're bid out. So provide as much information as possible, be as transparent as possible, get a great partnership attorney, and, do some reps, make up a deal and call your aunt and uncle and friends and say, hey, I have this deal. It's not real, but would you do this? And then talk to your partnership attorney and, say, hey, and, maybe spend the money to do a fake operating agreement or have him send you one and get the reps so that and you can never get the exact reps that you're going to need during a real deal, but think about what it's going to look like and make sure that you have the team in place as much as you can before you get a deal under contract. You have a 30-day due diligence and you got to figure this out in 30 days.
Another quicker way to speed it up, but the learning curve, if you want to get into syndication too, is to go be a small limited partner on a deal, so that you're creating these relationships with other general partners that have a lot of experience. They're grateful that you're investing. Even sometimes they'll go as low as maybe $50,000 that you can put into a deal. Maybe they'll make an exception for you, maybe even go a little less. Sometimes it's between 50 and 100 they want as the minimums. But you can go ahead and you learn from the process, and they will be completely open and candid with you, or they should be. It's an SEC requirement to be. You get on the quarterly calls, you get the reports, you see the offering memorandum and everything they're putting out there, and it's a great way to learn. And then maybe if you come up with a deal and you find a deal, those same GPs might help you with underwriting or help you with acquisition. And I think that's another good way to just kind of get your foot in the door.
I think if you want to do it, find an operator who does it. Mm-hmm. Whether they syndicate or they do joint ventures where it's just them and one large LP, find someone and ask them if you can do work for them for free. Hey, how can I help you? I'll do cold calls. I'll oversee the bookkeeping. Can I just hop on a call and listen to you and ask thoughtful questions and learn from someone else who's doing it? I think a lot of people, including me, sometimes are, I don't want to bother them. I don't want to, I'm a little embarrassed. I don't know this. Just, hey, you know nothing. None of us know anything. And so ask, be polite, be respectful. And I think the best way is to hey, how can I help you? What can I do? Oh, I've got these 4 owners that I just can't get in touch with. All right, I'll go knock on the doors. Like, bring value and find operators that you can just Google it, or you can go on YouTube and search real estate syndication or real estate private equity or joint ventures and find people online and ask for help. And even if you don't have the $50,000, you can still ask, hey, would you mind sending me your quarterly updates? I'll sign an NDA, I'll do whatever. And then if you get it, don't just get it. Write, hey, here, I came up with 100 questions. And the operator might be like, oh my gosh. But at the same time, I have people who do that with me. Answering the questions helps me realize what I can't explain very well or what I can. And obviously the best way to learn is to teach. So I would say find an operator that is doing it, offer help or create value for that person, and ask questions and be proactive.
Makes sense.
Yeah.
That makes sense.
So
Do you charge an asset management fee on your deals?
yeah. So there are other fees associated besides the structure that we talked about. For example, there are fees such as an acquisition fee. Let's say,
What does that look like? Typically?
So it really depends on the size of the deal. But let's say, Larry, you were working on a seller for 10 years and you got an amazing deal. It wasn't marketed, and right away you're buying it at 80 cents on the dollar. So, and who knows, call it $1 million deal, $5 million deal, whatever. It kind of depends, but I would say anywhere from a quarter of a point, so 25 basis points, to, you see some of these, online syndicators like 5 point. But I would say like 1 to 2 points is probably 1% to 2% is probably the ballpark.
Yep.
Now, if it's a marketed deal, it's probably a little bit harder to swallow that because you didn't find, you just got an email in your inbox. You didn't necessarily source it as well. So there's an argument to be made that the asset manager or the acquisition fee should be lower because you just got an email versus you spending 6 months running around, not getting paid $1 to find a deal, to bring it on a silver platter to someone who could make a 15, 20, 40% return on their money. There's also an asset management fee, which is for overseeing the asset. So it's different. The property management fee goes to the property manager who's answering calls on the toilet's broken. They're doing some of the leasing. They're overseeing the tenants in the property. The asset management is more, what is our strategy? What do we want to do? All right, let's start with landscaping. All right, let's bid out the landscaping work. Then let's do our roofs. Let's bid out the roof. And not only that, let's talk to our property manager. What's happening at the asset? How do we want to push rents? Where do we not want to push? Do we renovate? And just overseeing the general, moving the ship in the right direction. And on top of that, overseeing all of the quarterly reporting, which takes a lot of time. We typically send, 5-page quarterly updates with pictures and writing and the updated budget and the financials and updated rent roll. So putting all of those presentations together take time. So it's basically just to pay for your time that you're spending overseeing the asset.
And that's time consuming.
It's very time consuming. And a lot of times, honestly, the asset management fee is probably not remotely enough for what you're doing, but it's supposed to help at least, pay for your time. And if you hire someone to do that for you, pay for their time. So, a lot of people can say, oh, there's an acquisition fee, there's an asset management fee, but like anyone, you have to get paid for your time. If I run around for 2 years and meet with 1 million owners and I get one deal, like a broker, right? Like sure. I've been working on this sale for 4 years and I'm getting a fee because it's not just the day I close, it's for the 4 years prior to that. And then the asset management fee is part of it too.
What does the asset management fee look like in your world?
It depends. You see some people do it as a percentage of revenue. And then you see some people do it as a percentage of equity. So if you raise $10 million and it's 1% acquisition or 1% asset management fee, then obviously it's $100,000 a year that you're getting, typically paid quarterly or however you structure it to oversee that property. Or sometimes it could be a percentage of the revenue.
What do you like to do?
I typically just do it as a percentage of the equity.
Yeah, it's easier.
Yeah. And you're not constantly trying to calculate it. And it also, obviously you're incentivized to keep rents high, but sometimes it might make sense to bring rents lower to vacate a building because you have to do work on it, but you're not incentivized to do that it just makes it cleaner. It's a flat fee and LPs don't have to worry about it going up if we really start getting crazy rents. And so it's it's pretty transparent, and so everyone kind of knows what it is. So there are no questions about it.
So we've kind of said this, but to communicate, like you get paid you get paid if you're a syndicator. You're getting paid typically when a transaction closes. You're getting paid at that moment, and that could vary. Then you're getting paid annually on the asset management fee, and then the real money, in theory, is when you either refinance or sell that property. Because, like you said, you don't really get paid that promote, if you will, until the principal's paid back, which
Correct.
typically almost always is happening when a refinance event happens or a sale happens, right?
Correct. There has to be a capital event. Yeah, exactly. So it's a refi or sale, or maybe you do a recap, but that's more rare. So it takes time. But that's where the real, don't get me wrong, the fees help keep the lights on and help pay for your time that you're spending on these properties, but it's not, no one's living off of these.
Right. So the sweet spot is maybe you're 5 years deep into syndication. You've been doing deals, and you're refinancing these things now at this point, or selling these things at this point. And now you're really getting those checks, right? That's where you're really making money.
And there are pros and cons to it, right? The pros are you get to work with friends and family who maybe can't write as big enough check, and maybe you have a little bit more control because there are more people, more cooks in the kitchen. The downside is you have to get sometimes 20, 30 checks, right? And trying to get you plus 28 people to send money in on a certain day and then do K-1s, tax returns for every single person, is a lot of work.
Yep.
And sending out wires every quarter is a lot of work. Now, the benefit is that, again, you get to work with your friends and family. Maybe you have a little bit more control. The downside is you have to deal with so many people. Now, doing it with one group or one investor is you now have probably are giving up potentially major decision-making rights. So in my opportunities, my investors trust me to make the right decisions in terms of refinancing or to sell the asset. And if you're doing it with one group, they might say, we have major decision-making rights. So you can't sell or refi without our permission. And people change at companies. You might think you're dealing with Larry, and then Larry leaves and someone else comes in and they've got a different way of thinking about things. So you give up a lot of control.
Or different time horizon
and
too.
different time horizons. Yeah. So there are pros and cons to both. If you can find one large investor who trusts you and will fund all of your deals, and you can still have some decision-making rights, amazing. Tough to find. But like I said, there are pros and cons to both. When it comes to much larger deals, it's obviously much larger to raise, 100,000 checks to capitalize a $10 million deal. So you probably have to go to a larger, group or high net worth, but you give up something as well in terms of being able to have control over the deal. And you can also feel like you now have back to a 9-to-5 job, right? You got out of this to try and work for yourself, and then you now are really working for this one big LP that has certain accounting requirements or whatever. So no way's perfect. There are pros and cons to both. I think it depends on the size of the deals that you're doing, and you're realistically not going to get one big check without the experience. So most people have to start with friends and family from the start at a smaller level and then grow.
Sure.
And back to time horizon, on your projections for the deals you've done on your syndications, what has been your projected time horizons, and where are you at in those time horizons? And do you think you might be extending those, or maybe you got more aggressive and did a refi prior to what the time horizon was? Or
so the way that
how do you navigate that?
Yeah, good question. The way that the operating is structured is that we can, I have the discretion to hold for as short or as long as I see is the best possible to maximize return for investors, which is another great thing, right? If you have one large investor, you're going to say, hey, we have a fund, we have to sell by month 36. So I have the ability to hold or sell based on market conditions and business plan execution. So as of now, I usually show a 5-year hold without a refinancing. Refinancings are, you don't know what the rate's going to be, when they're going to be, and it usually just juices the return. So I try and show we don't refinance, we hold for 5 years, and this is what that would look like. Now, a lot of things can happen. We can hold longer, we can hold shorter, we can refi, but I usually show 5 years, but have the ability to change that. Most of our deals or all of our deals we've owned for less than 5 years, 3 years most. So I think there'll most likely be a refinancing for some of these, maybe a strategic sale. But I think if talking to a lot of my investors, they say, if we sell this, now I got to go put the money somewhere else and I got to pay taxes on it. If you do a refinancing, that money is tax free, right? You're just shuffling the cards on the debt side. So if you actually do the analysis, the refi sale analysis, the numbers aren't that different. Obviously depends on a lot of factors, a lot of assumptions that go into it. But let's say for a deal, if you refi, you can refi out $3 million of equity and you put 3 in. So now you pull all your money out. And if you sell, maybe it's a $5 million gain, but then you got to pay depreciation recapture. Now you got to pay taxes. Now you got to pay long-term capital gains, and you might net making it up 3.5. So now you have no more income. But if you refi, you have the 3 plus you're still getting quarterly checks. So I think if you were to ask most of my investors, they say just refi and hold this thing.
And it's like infinite returns at that point. They've gotten, meaning they put $500,000 in with you. They get $500,000 back at the refi event, and then they still get a check. Maybe the checks are smaller now.
Correct.
But
checks will be
getting
smaller.
checks. That's
Yeah, and there's another chance to refi in the future or sell.
Or sell it as the asset appreciates. Maybe you keep it another 5 years and.
Yeah. So it depends on the investor. It depends what they want. Everyone's different, but I think it's transacting there's a lot of friction costs that come, you got a sales broker, attorneys, taxes. And if you can refinance opportunistically, I think that is, can be ideal. The only downside for the operator is, as I mentioned, you get paid on primarily off of this carried interest above a certain hurdle rate that you set. If you don't refinance all of the equity, you're probably not going to hit that. So you're delaying even longer. So a lot of these operators are incentivized to sell as fast as possible because it gets that IRR up as high as possible.
You juice it. Yeah.
So I think for most operators, they'll tell you they'd rather sell because they get their promote. But if you bought well and the market has gone up and you can strategically refi and maybe get in the promote then or get close to it, a lot of the people who hold forever will tell you it usually takes us 2 refis to get into the promote, which is a long time. That can be 10 years. 10 years. But you have to think about, what does my capital want? And it's not just me, right? I'm 10 to 20% of these deals. What do they want? And I want to do best by them. And I want to put myself last. So if it's best for the deal to refi and for everyone else, and that's what they want, then we should do that.
But even putting yourself last, if you are just thinking, even selfishly a little bit, a tiny bit, which we all would, we just talked about for the first 20 minutes of our conversation how difficult it is to find really good deals here. So you're in a home run deal. Today, finding a home run deal it's not impossible, but it's pretty darn hard.
Right.
So are you going to go sell? Yeah, you make your promote. Nice, but then what are you doing after that? Now what?
Yeah. Call that the magic trick, right?
Yeah.
Finding the deal.
Yeah.
Can you perform that magic trick again? And how many times can you do it? And after I get one done, I'm like, let's put that in the bag and keep it. Yeah.
I think a lot of it depends on who your limited partners are. Because if you're partnering with a private equity firm and they've got a fund life and they've got to sell by year 3, obviously you don't have the ability to do that unless you recapitalize with a new LP in the future, which can be complicated. But a lot of the times your LPs are driving that ship.
Have you had any LPs that are more or less like, hey, I need my money, so you've had to recapitalize and substitute in 1 or 2 here and there?
No, we have not done that. To the extent that someone came and said that, absolutely open to that. Okay. But no, and a lot of the LPs are, they have significant amounts of money, and it's not,
it's not the lion's share of their equity.
But
right?
to your point, it can be that can come up. It hasn't come up yet, but if it does, in our operating agreement, it does allow for me or someone to buy them out, and but it hasn't happened yet.
Got it. Okay.
The other thing is if you disposed of the 76 doors you had, you'd now be at 100 whatever doors, and so the efficiency of your operation not perfect either, right?
Exactly right.
So,
yeah, exactly. It's And also, as you start to talk to brokers, as you guys know, how many doors do you have? Oh, I have, I had 200, now we have 15. Like, you have 15 doors, or whatever the number is.
That's true.
Now you start to maybe not be as we'll call you, but
I call it your resume. The number of doors is the top line of your resume.
Right.
Yeah.
And the problem, I will say, the problem with number of doors is we all know, right? It's like anyone with money
If you
can
own
buy
2%
multifamily
of 1,000 doors, you could own 60 doors on your own and actually have more
Right.
net worth than that person. But,
or you can just, like the three of us, if we just said we're going to buy everything in the market right now, we could do that. That doesn't mean that these are good deals or that. So it's obviously number of doors is great, and that's probably the way that we can compare this company versus that company. But as we all know, you could overpay.
There's more below the surface.
There's a lot more below the surface.
Sure. It's the tip of the iceberg, literally. Yeah.
No question.
Are you looking anywhere else for deals besides South Florida?
At the moment, no. Actually, I take that back. Starting to look up kind of more towards Orlando too. So call it Orlando to really like Fort Lauderdale is the strike zone on the East Coast. I've looked at a couple things on the West Coast. I'd love to eventually look, out in more places. But as you know, real estate is a block by block business. And I truly believe that you have to be in your market, or you have to have boots on the ground. You need to know all the. I have a difficult time understanding the people who are investing in. Oh, we bought a deal in Dallas, then in Sacramento, and then I'm like, how do you know all this? There's just so much on the surface level. Hey, operating expenses are the same, revenue's the same, but it's really not. It's very, very unique.
I feel like if you dropped me in a 30-day diligence period in a deal in a city that I haven't been in or an area that I haven't been in, I could get pretty smart, but I don't think I could feel comfortable enough to really do that deal unless it's obviously just cheap. And so most of the times that's not the case. You're not getting the obvious cheap deal when you're not a master of your marketplace because you just don't know the people. So now you got to go in. So now you got to go pick the area. Then you got to go get to know everyone, and then you got to know the area as well. And so it's hard. I agree. I don't see that making too much sense to go outside of my area without picking. Maybe I could pick another location, like you just said.
I think there's a difference between finding deals and finding value. So you're finding value for your limited partners, for your investors, because you have market expertise and you're not ready to jump on any single one deal. You have patience, you're taking your time. Whereas finding deals, if you spread yourself out across the Sun Belt in 7 states, you're going to find a deal. You're going to find a 200-unit deal at some point, and you're going to go and you're going to underwrite it how you underwrite it. Maybe it's conservative, maybe it's you're underwriting liberally and more dangerously, but that to me is just transacting. You're transacting deals.
And if you're seeing a deal in a different market, you're not going to be the first person to see it, right? Like if I see something that's around what I own, I know that I'm probably one of the first few people seeing it. If I'm in a market that I don't know and I'm like, all right, who else passed on this? Yeah. Why am I seeing it? Do they think that I'm just going to be the guy who's going to buy it because I want to get in this market? So I say this all the time. If it's on the market, I've already missed the opportunity. That doesn't mean that I can't look at it. That doesn't mean that there might not be an opportunity. But I've missed the opportunity where the owner wants to sell, where the owner told the broker or a friend, hey, let me know if you have someone. I'd rather just do this quietly, because a lot of people want that, not everybody. Then they found a broker. Then the broker gave them a broker price of opinion. And then a broker opinion value. Then they got signed into a listing agreement. At this point, I'm so far down the line of people who have seen this deal, I'm probably priced out. So if you go outside of your market, my first question is, why am I seeing this deal? Who else have you shown this to? Why did they pass? And why am I seeing it? And why do you think it's a great deal for me?
Exactly. Yep. Yeah, I agree. Not to say that I wouldn't go elsewhere either, but because we've explored some places together, Jerron and I, and I'm looking north as well, but just hasn't hit yet.
Yeah, and I think too, as things get more competitive, you always go out, right? Everyone's chasing yield. the farther away you get from downtown, probably the higher the cap rate is, right?
Exactly.
But when the music stops, you want to be downtown, right? So that's another balance of making sure that you need yield, but at the same time, you're not going super west of in the middle of the state. You know, I'm not saying there aren't opportunities, but in South Florida, you're either going north or south, and it's probably north because everything south, you know, is probably more expensive, or you're going west. And you have to be careful about chasing yield. People who do deals in these super tertiary markets that no one's ever heard of, they're buying at a 12 cap. You're like, oh my, what a deal. But if they go to sell that, there might not be a single bid. Yeah. And so, you know,
or
that
if the market cap rate there is 10%, or I'm sorry, 12%, sorry, then you're just buying it at what the market rate is. But if they're buying, you're buying a 12 cap and the you know, the market cap rate is 10%, okay, then you got a decent deal there.
Yeah.
You know, that's a good start, but people they say cap rates, they use cap rates a lot. Okay, well, yeah, but you got to understand cap rate is what the market is saying that this asset is worth. So you got to find a yield that's better than that.
Yeah, I think cap rate is obviously something that we can all, it's like a multiple on earnings when you talk about P/E ratio in equities. It's something that we can all talk about and think about, but in reality, I think there should be a greater emphasis put on location, on vintage. You know, at the end of the day, you're buying a piece of real estate, right? Yes, it's cash flowing. Yes, you're going to get paid a distribution, hopefully, if everything goes the way you plan to, but you're buying a piece of real estate. And I think that if you ask most people who have more experience than I do in downturns, they will tell you, I really wish I would have paid a 4 cap versus a 5 cap to be here versus there, because all my renters are leaving and going there because rents are lower. So I think, not that you want to overpay for location, but I think that it should be something that's way more focused on by investors than just a cap rate.
I think a good example of that is over the past, let's call it 2011 to, 2015, 2017. I mean, especially 2011 to 2015, how many deals I passed on in downtown Delray, right? 3 blocks off Atlantic Ave, right? Kind of worked, but didn't work enough as my other rougher properties that I ended up purchasing in the hood-ish areas. and yeah, they had a higher yield. But if you bought in Delray, 3 blocks off the Ave, that's a genius move today.
That's where the appreciation goes typically is to the low cap rate Class A areas, or especially areas that are gentrifying, you know, they're seeing that gentrification. And that's exactly what happened with Delray.
I think a really important thing to keep in mind is, what is the quality of my revenue stream, right? If I'm buying a property in Delray for a 4, my tenants can probably afford a big rent because they're right off Atlantic Avenue. They probably have great jobs. They probably aren't going to lose those jobs because they're great at their jobs. They may have moved down here from a big market to it. And so you're much more likely to get paid from that tenant a lot of the times, not all the time, versus, well, this is a better yield, but that person probably has a job that is maybe a little bit more volatile. They might leave. So I think looking at rents as, who's my renter? What do they do? What do they make? That is extremely important. Rents are not created equal. $1,500 here, $1,500 here, maybe the same number, but it can be an extremely different quality of dollar that you're getting. And that's a really important thing to keep in mind.
So I think what we're trying to say is we're looking for a risk-adjusted cap rate, right?
Yeah.
Right? Like that's probably the answer, which is like in our business, it's really hard to do that. Like in the stock market, you can kind of do it, right?
Yeah.
But in our business, everything is the information is not as readily available. It's not as understood. There's not as much data. So you just, like, you can't really, it becomes an art.
It's like, I wish in underwriting there would be a line item on your Excel spreadsheet where you have like a pain formula, a pain rate.
Yeah.
Because, when you're dealing with Class C properties, maybe you're underwriting okay, maybe the vacancy rate, but I find most of the time people are underestimating vacancy rates in Class C properties the amount of evictions that we have. I know our firm does more or less about 300 or more evictions per month across the state of Florida, and I see the same evictions over and over and over again from the same investors, the same LLCs. I could go down my eviction spreadsheet that has 18,000 evictions in it just from 2019, and I'll scroll up and down, and I will see the same LLCs over and over. It's because they own these 200 units in a Class C area, or they own 150 in another Class C plus area, and it's, they so that I don't know what they underwrote, but it probably underestimated the vacancy rate based on a number of evictions and turnover that's going on there.
And costs associated to turn it over.
Yeah.
Like the thing too, in that vacancy, there's a lot
Well, we
baked
talked
into
about
that.
$6,000 in a turnover.
Yep.
Maybe they have for 200 units, maybe they have a full-time handyman, so maybe it's not 6,000, but even if it's the vacancy rate plus 2,500 or 3,000 for new paint and whatever you're doing and fixing what these Class C tenants are beating your property up, that's painful too.
Yeah, it's also important to remember how difficult it is, that everyone wants these quality assets and quality locations. There's a reason why you go outside of them, because you can't find anything and it's too competitive, right? So you have to go to these maybe more difficult areas to find opportunities. But I think if you have a long enough time horizon, you say, hey, I'm going to prioritize a certain vintage, a certain area, and that's going to be what I'm going to focus on, and I'm not going to get persuaded by some great return in this area. And it's a responding to disasters and headache business, and you get to choose we all get to choose what headaches we have to deal with, where they're located, who the tenants are. And I think it's important to remember that you want quality, and that's in everything in life, right? You get what you pay for. Yeah. And don't get me wrong, you can make money off of Class D, Class C, but is it worth the return on effort? And that's an important statistic that I don't think enough people take into account.
Said a different way, the arbitrage that you're looking for, the value you're looking for, is finding that Class C property in a Class B area, or Class B property in a Class A area. And then you do the value add and you turn it from a Class B property to a Class A property and have Class A tenants. So.
Yeah, the magic trick.
That's the magic trick. That's where the magic's at.
Yeah. And then also one last thing I'll say too about looking at some of these older properties is, obviously real estate has a useful life. In terms of the IRS tax code, commercial properties 39 years, residential 27 and a half. Obviously it's longer than that. But if you're buying 60s construction, 50s construction, you got to start looking at that as a covered land play a little bit. Look at the actual land. Don't just look at the real estate and the numbers and what it's generating. If it's a 2010, 2000, 90s vintage, okay, maybe you don't have to look at it as much, but think about what the land value is. Think about what the as-of-right zoning is on these older properties, because at some point, every property will be a development site, and how close are you to your property to be the highest and best use to be actually built as something else. So it's important to think about that, because it's something I never did, but I'm starting to think about it more. Especially a lot of these older buildings are legally non-conforming. So they built 60 units, but today they're only zoned for 40. So now you're saying, okay, well, at some point, unless there's a Live Local Act, which I think we're all aware of, where if you have zoning within a mile of you and you provide a certain amount of affordable units, you can match the zoning. But important for people to remember that these older properties, yes, you can continue to renovate them, and I'm sure they can last for 100 plus years, whatever, depending on where they are. But it's important to think about them potentially as development sites. And then also, I don't want to talk anymore about insurance, but insuring these older properties is even harder. So just give another second thought about looking at these really old. And Florida's lucky because, it's not like New York City where you have really, really old properties. Probably oldest here is maybe 20s, 30s, something like that. So you don't have that old, but something to think about is look at deals based also on their land value, what you can build if they are older.
We toured some property outside the area recently. Jerron and I toured like 20 properties, and they were all wood frame construction and in some, tertiary markets, as you mentioned. And we were looking at these assets, and all I could think to myself is, we buy Class C stuff in Class C to Class A neighborhoods typically, some Class B product, but all I could think about is, man, our Class C stuff is in way better shape than the stuff we were looking at, and it was just an eye-opening event to kind of tour that stuff and really see what else you can get out there. And so I think it's a very good point you're making. You really have to kind of understand the age of the asset you're buying.
Yeah, yeah. And when the market's good, people don't care. When you saw interest rates go to zero, all the big institutional investors, they took their 70s and 80s and 90s vintage assets, they sold them for 4 caps because the cap rates were the same, maybe not the exact same, but similar between A's and C's, and they traded up to better quality assets. That's what they did. They said, we're selling all these properties. People are like, hey, we're in a great basis. They said, well, we're going to trade up to better located, better quantity real estate now. And when that boom continued to rush and everyone was making all this money in real estate, what year is it? Don't care. It's in South Florida. It's multifamily. Then when the tides turn and rates go up, what year is it again? What is it, cast iron? Well, I don't know about that. So when the tides change and you're caught in a older, tougher area, you realize how much that can make a difference.
Yeah, I noticed that in the residential brokerage space right now. The deals I'm brokering, there's more discussion during the inspection period. There's more scrutiny put on mold inspections, drain line inspections, roof-related stuff.
Or permits pulled for these improvements.
Right.
We're seeing a lot of that.
All
they're
that
crossing
stuff.
that. Before they didn't care. They walk in and, hey, it looks good. Okay, you have 24 hours because I got 3 other offers that are on the way. So, sign on the dotted line or move on.
Yeah, it's happening, and deals are falling out for a number of reasons right now in my little residential bubble.
Yeah, and as I said, investing is about timing. And right now, you've seen the tides change from a seller's market to a buyer's market. Sellers a year ago, maybe you know better than anybody, what's the number? We'll close in 24 hours. Now, tough to sell things, tough to find buyers. And it's just, if you have to zoom out and say, where am I? Where am I in the general economic cycle? And you also have to be a little bit contrarian because obviously the best times to buy. If you want to own Florida multifamily and prices have come down 20%, you probably feel pretty good. I should buy everything. So if you have a long enough horizon, but timing is really everything.
Agreed. So this has been awesome, super informative, JJ. You're a rock star. So and thanks for the
thank you for having me
information dump.
both.
Yeah.
Yeah.
No, I've learned a lot from you, and this is great. How can people get in touch with you if they have questions about syndicating deals or they're looking to invest money or what
Absolutely.
does that look like?
Our website is anchor-equity.com, anchor-equity.com, and there's a contact us page. They can just go there, fill out your name, fill out a question, press send, it'll come right to me, and that's probably the best way to get in touch with me.
Love that. Yeah. And we'll put that in the description of the video
Perfect.
as well, so
Great.
they can click on that. This is great, Larry. Any other questions of JJ?
Yeah, it's a pleasure, man.
Yeah, me too. Thank you so much for having me. I really appreciate it.
Yeah, been awesome. Thanks.
Thank you.
If you'd like this video, please like or subscribe.